flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures pushing higher today after the S&P 500 suffered its worst intraday sell-off this year amid Friday's rout. Investors are looking ahead to key inflation data out later this week for any signs on progress in the Fed's fight against inflation. The Fed's preferred inflation gauge, core PCE, is expected to cool to the slowest pace since June.
Plus, investors are laser focused on Nvidia earnings out later this week. The AI chip giant's guidance on growth is going to be a key focus here as the company deals with supply challenges with its Blackwell chips and also potentially tighter controls on sales to China.
And finally, Apple gearing up for the impact of Trump's tariffs. The company announcing plans to invest $500 billion in the U.S. over the next 4 years. Apple plans to hire 20,000 workers to produce AI servers as it seeks relief from Trump's tariffs on goods imported from China. The stock market and the reaction here that we're seeing pre-market, Apple shares falling here. Also sticking with AI and data centers, Microsoft has canceled some leases for U.S. data center capacity, according to TD Cowen. The reason for the cancellations is unclear, but TD Cowen suggests it may be due to Microsoft being in an oversupply position or reallocating investment to the U.S. from abroad. U.S. stock futures staging a bit of a recovery pre-market today after the S&P 500 saw its worst intraday sell-off this year in Friday's session. There you're taking a look at some fractional gains across the board here. I was taking a look at the note from the trading floor, our good friend of the show, Michael Reinking over at NYSE, senior market strategist there, and he mentioned that the S&P 500 has proven to be very resilient over the last few weeks, shrugging off a multitude of headlines from Washington. But one thing that they've been focused on as well is the growing level of uncertainty and how that has the potential to stifle economic activity, and that also flowing through to the mindset of investors last week, and we saw that play out.
Yeah, Brad, I think you're exactly right, and the question is whether or not that momentum can continue, whether or not the investors and really the broader market can continue to almost focus on the more rosy side of the picture and able to shrug off some of those concerns. When it comes to what is really going to test some of the market's momentum this week, we don't have to look any further than Nvidia's results. Very much the focus here, not only for the tech trade, but also just the broader market sentiment. Clearly, maybe not carrying as much weight as it has in quarters past, just given the lackluster start to the year, given the fact that there are a lot of unknowns and a lot of headwinds, challenges baked into this, some of this slowing momentum that we have seen in Nvidia stock, but still very much a bellwether here of AI investment of the tech industry at large. So, of course, that is going to have a big impact here on the broader markets as well.
Yeah, absolutely. The bellwether that we've been waiting for to report earnings, of course, as we've gotten through some of the biggest retail names. And you think back to Walmart and what happened last week, the indicator that we've largely been looking at here in consumer discretionary and consumer staples relative to consumer discretionary as an early warning sign in that relative performance here. That was a major drop that we saw in Walmart last week and really kind of gave us a sense of how much some of the interim plays in the consumer staples and for Walmart, they kind of fall at the center of that within some of their merchandise aisles, but then also the consumer staples within the grocery aisles for Walmart here. And that also led a larger kind of sell-off that we had seen in some of the other retail names too.
Yeah, and also just one of the themes that we have noticed here over the last several weeks is selling on Friday and then almost a relief on Monday if we don't see any worrisome headlines, particularly those coming out of D.C. and kind of on the policy angle. That has clearly spooked the markets in weekends past. When you take a look at the fact that we didn't really get anything huge market moving over this weekend, we are seeing a bit of a relief here in the pre-market. All three of the major averages on track to open the week and open the day in the green. So we'll see whether or not we can carry that momentum here into today's trade.
All right. We're also tracking Apple this morning. Apple announced that it will spend and invest more than $500 billion in the U.S. over the next 4 years, including plans to build a new factory and hire around 20,000 workers. Host of Market Domination, Josh Lipton, joins us now here with the story. Hey, Josh.
Brad, that is right. Big news this morning from Apple. The iPhone maker plans to spend and invest more than $500 billion over the next 4 years here in the U.S. CEO Tim Cook saying in a statement, "We are bullish on the future of American innovation, and we're proud to build on our long-standing U.S. investments." Specifically, Apple says it will hire around 20,000 people over the next 4 years. Most are going to be focused on research and development, silicon engineering, software development, and AI and machine learning. Build a new manufacturing facility in Houston that will create thousands of jobs. The 250,000 square foot factory is slated to open, Apple says, in 2026, producing servers to support Apple Intelligence. The company will also double its U.S. Advanced Manufacturing Fund to $10 billion. That fund's expansion includes a multi-billion-dollar commitment from Apple to produce advanced silicon in TSMC's facility in Arizona. Additionally, Apple's going to establish a new academy in Michigan where it says its engineers are going to consult with businesses on implementing AI and smart manufacturing techniques. As Bloomberg notes, all of this is coming just days after President Trump said Tim Cook promised him hundreds of millions of dollars in U.S. investment and that the tech giant's manufacturing would shift from Mexico to the U.S. They don't want to be in the tariffs, Trump said. Now, there is a risk that Apple could be among the companies negatively impacted by fresh trade tensions between the U.S. and China in Trump's second term. Cook is among those American tech leaders who has worked to reestablish or overhaul their relationships with Trump. Following his re-election, he has reportedly traveled to the president's Mar-a-Lago estate in Florida, as has Meta CEO Mark Zuckerberg, Alphabet's Sundar Pichai, and Amazon founder Jeff Bezos. Following this announcement, Trump did thank Cook and Apple in a post on Truth Social, saying the company's investment is based on faith in what we are doing. Shauna, back to you.
All right, Josh, thanks so much. Let's continue this conversation here with Apple making the historic investment in the U.S. economy. Tech giant, like Josh said, is going to invest $500 billion in U.S. manufacturing efforts. Here with more on this, we want to bring in Gil Loria. He's the head of technology research at D.A. Davidson. Gil, it's great to have you back here on Yahoo Finance. Let's start with the announcement that we got from Apple here this morning. Is this a smart strategic movement or move here at the right time?
Well, making President Trump happy is always a good strategic move for a CEO of a company who's very much exposed to the types of policies that are going to come from this administration. I would focus less on the bombastic number. Again, this is a number that's made to make a political statement, but more on the fact that some of these investments may actually be incremental. A plant in Houston may be incremental. The overall number likely includes, for the sake of conversation, cost of goods sold, SG&A, et cetera. It's probably not incremental CapEx. That's more political. But there may actually be some domestic investment that is incremental that was not previously planned, so the company can get in good graces with the president.
How should investors evaluate this, especially as the upfront dollar figure would lead to the question of when does that flow through to some of the financial performance for the company?
Given how big Apple is, I wouldn't expect these investments to change the economics of the business very much, especially not over time, especially given how long it takes to open a plant. And I would just focus more on the fact that if it's aligned with the president, with this administration, it's less likely to get ensnared in the U.S.-China conflict, which is really the primary goal for CEO Cook, is to not be a victim of China raising tariffs, of the U.S. raising tariffs on imports from China. They don't want to be in the middle of that.
Gil, what about, does this signal anything about how Apple is approaching just manufacturing overall in China?
Apple has already started diversifying away from China a while ago. It will continue to do so. If the focus is India, the focus can also be the U.S. The difference in manufacturing between China and the U.S. isn't what it was 20, 30 years ago. It isn't even where it was 10 or 15 years ago. And so it does make sense for Apple to diversify away from China, take as much production out of there. And if it can move it to the U.S. in an economic way, that is a prudent decision, especially if we do have a regime of higher tariffs overall. The more you manufacture in the U.S., the more you're insulated from that.
And so all these announcements considered, I mean, we've seen, it seems like major dollar figure CapEx rollouts over the start of the year and even going into the last earnings period as well here. How do you kind of look through these and then ultimately for investors who are trying to figure out how Apple and the exposure that they also have to any tense relationships between the US and China, how that also plays out too, because there is a significant revenue exposure in that region.
Yeah, China is Apple's most difficult market. It's the most competitive and dynamic market. They have a lot of very strong domestic competitors. They don't have their full suite of AI products rolled out there yet. So it's already become a much smaller part of the business than it used to be, and it's not going to get any easier. That is why they have to invest elsewhere and try to grow other markets. Again, India is a promising market, but they also have an opportunity to roll out Apple Intelligence globally and have that support the growth. In terms of CapEx, let's not forget Apple has chosen a much lighter model than some of the other mega caps. A lot of their AI is going to be done on the phone. It's going to be done on the Mac. They're not necessarily building as much data center capacity as your Microsoft, Google, Amazon, and Meta. And that actually gives them an advantage in terms of how adaptive they can be to where AI is headed.
Okay, let's talk about one of the competitors out there, and that's Microsoft, TD Cowen, or maybe not so much competitor, but more broadly speaking, when we talk about big tech and some of the movement that we are seeing in regards to AI. TD Cowen was out saying that Microsoft has dropped some of its AI data center leases. I'm curious from your perspective whether or not that is true, but the fact that that line of thinking is out there right now, what are the implications of that?
Yeah, very broad implications. Microsoft, let's not forget, is the one that started the great data center build out. They invested early in OpenAI, and when ChatGPT broke through at the end of 2022, Microsoft started accelerating its CapEx faster than anybody else. They got the biggest allocation of chips from Nvidia and more than doubled its spend, even as a part of revenue since then. What they're telling us now, and Satya Nadella has been pretty consistent over the last few months, is that maybe they've gotten to a level that they can just sustain and plateau at. They just spent a lot in the fourth quarter, the fourth calendar quarter, but they said for the next couple of quarters, their spend is going to be flat. And then in their next fiscal year, they're going to grow CapEx less. So it makes sense that they're reevaluating the portfolio of investments and starting to moderate it. That will then cause other mega caps, especially the hyperscalers, to reconsider their plans. Right now, Amazon's still talking about increasing their spend this year. Google's talking about increasing their spend this year. But we already heard Amazon say, we're only going to stay flat from where we were in Q4. So the signaling is happening that the data center build out is moderating, at least from the hyperscalers.
So then, Gil, I guess more broadly speaking, then what's the ultimate takeaway then on demand and what that demand picture looks like?
Well, if you're starting to look at Nvidia, who's reporting Wednesday after the close, this year is going to be great. The fourth quarter will absolutely be a huge record. And the rest of this year is pretty secure in terms of what their largest customers are going to spend. It's really next year that you have to start thinking about. If Microsoft is plateauing, if Amazon's plateauing, if Google starts talking about that later this year, Meta may start talking about the fact that they're at a good run rate, then we may not be able to deliver the growth investors are expecting for next year.
We already know that the long Mag 7 trade is the most overcrowded trade that's out there right now, and Nvidia set to report earnings, as you mentioned a moment ago. This could perhaps make the thesis further, though, for the larger AI narrative and add more fuel to the fire here. But just how much more fuel is there, you think, in that trade?
So we've already seen a rotation, right? The early winners from AI were Nvidia and Microsoft, and up until the middle of 2024, those are also the stocks that performed the best. We've already started rotating into more software-oriented companies, the companies that will actually build these solutions. And especially, we like the software infrastructure companies, Snowflake, Datadog, JFrog, companies that build the tools that make it possible for applications in AI to be delivered. That's where the puck is headed. And when those tools are robust and when these applications start getting built, then those application software companies will benefit. That's probably 1, 2, 3 years down the road.
Gil, always a pleasure to get some of your insights. Thanks so much for joining us here this morning.
Thank you.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we break down Warren Buffett's latest shareholder letter as the Oracle of Omaha increases his cash holdings. And we'll have more coverage on Nvidia ahead as investors gear up for earnings. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Alibaba here, about to invest $53 billion in AI infrastructure over the next 3 years. That's more than the company has spent on cloud and AI over the past 10 years. The Chinese online retailer says the spending, quote, underscores the company's focus on AI-driven growth and its role as a leading global cloud provider. Shares, they are down by about 5.3% here going into the start of trading activity here. But the planned spending here, it also on AI infrastructure matches half of the initial $100 billion investment Stargate AI plan promoted by the U.S. here too. So all these things considered, Alibaba and the leadership team have made some significant commitments trying to appease both investors and the AI build out, but as well trying to please some of the geopolitical counterparts too.
Yeah, certainly. And this is on the back of some of the commentary that we got on the earnings call last week, where Eddie Wu very much doubled down, talking about the opportunity that lies ahead when it comes to AI. AI certainly overtaking that earnings call. I think that was a big takeaway from analysts last week. And we certainly saw that reaction play out in the stock moves last week, a lot of that excitement. But when it comes to the degree and how significant this spending is, the 3-year CapEx plan is 39% higher than the total spending here from Alibaba in the past 10 years. So we talk about the plan to spend more and more on technology, spend more and more on AI. Alibaba very much following through in the footsteps of some of the larger tech giants here in the U.S., just in terms of what they're seeing demand-wise, what they're seeing opportunity-wise. We know Eddie Wu in the past has said that more cloud growth seen in the next 3 years than in the last decade. A lot of that being driven by that growth opportunity there. So very much we have seen that excitement surrounding the stock over the last 2-year chart, where you're still looking at some losses there. But again, when you take a look at the fact that we have seen much of that excitement return to the stock here most recently, especially in the heels of the earnings results just last week. No surprise that they are then further doubling down on this. Although when you take into account more CapEx spend, we are seeing the shares under a bit of pressure here this morning. But again, that excitement, though, I think more so for that longer term opportunity.
Yeah, this is a major investment, especially as they're looking to achieve their first quarter of profitability for their AI data center within the next fiscal year here. So trying to supercharge some of that ability as well.
Yeah, year-to-date gains of just about 71%. All right, let's take a look at Robinhood, another stock that's actually done very, very well here over most recent weeks. But the SEC is dropping its investigation into the company's crypto business and has no intention of moving forward with an enforcement action. This comes days after Coinbase announced that the SEC did agree to end its enforcement case against it. You're looking at shares pop just about 1.5%. This is a stock that has done tremendously well since Trump was elected here as president. Take a look at some of those gains. The stock up just about 160%. Yes, it is coming off its worst week that we've seen since December of 2021, but putting it into more broader context of the gains that we've seen since the November 5th election, we are still looking at a jump of just about 160%. This, of course, the news out that we're getting this morning, removing another potential overhang here on the stock moving forward. And I think it's fair to say overall, the street very optimistic maybe about some of the developments that we could see come from Washington, come from the White House, the new administration here in regards to crypto and what that looks like, a more favorable administration.
Yeah, just think back to how they talked about this on the earnings call as well here, saying that in January of this year, net deposits were their second highest month ever. Equities, options, crypto trading volumes were all up double to triple digit growth rates from a year ago. In fact, they went on to say January option volumes all-time highs there. And so all of these things considered, you think back to the margin balances as well here, and the balances for customers who are using the platform, continuing to put even more into those accounts, funding their accounts, and then even for what it means for Robinhood, how many of them are opting into that gold and premium tier as well? I think it was somewhere around 2.6, 2.7 million gold paying subscribers here. I'm going back to my notes here from a couple weeks back. But all those things considered for Robinhood in their growth trajectory, trying to extract even more of the average revenue per user because of that gold. And then additionally, looking across some of where they're looking at the tokenization of private assets as well. That's a major boon to the business in the future that they're thinking through as well at this juncture. We're seeing shares higher pre-market, 1.6%. Also here, we got to talk about the Oracle of Omaha. Warren Buffett released his annual letter to Berkshire Hathaway shareholders saying, quote, in 2024, Berkshire did better than I expected, though 53% of their 189 operating businesses reported a decline in earnings. Berkshire's cash holdings came in at just over $334 billion, nearly double the $167.6 billion reported in 2023. Joining us now to break down the biggest takeaways from the letter, we've got Kathy Seifert, CFRA Research, VP of Equity Research. Kathy, great to have you back on the program with us. Why is Buffett sitting on such a major cash pile here?
Well, I think we can glean a couple of messages from that annual, the annual report. And, he's sitting on cash because he doesn't think he has a good alternative to deploy it. Coupled with the fact that Treasury yields ticked back up. One of the reasons that Berkshire's numbers outperformed my estimates, which were like 10% above the consensus, was that investment income was significantly better than people were expecting. And insurance, the personal lines insurance turned around. So, the bar with Treasury yields where they are, the bar to look for alternatives is higher. And then, combined with the fact that equity valuations are certainly not where a value investor like Warren Buffett would like them to be. I think it's no coincidence that he's focusing on his Japan investments. I mean, he made those 5 years ago. I think he's if he does a deal, he may look abroad where valuations might be a little more attractive.
Kathy, talk to me a little bit more about that and kind of what you think the line of thinking there, just given the fact that he says that there is still a dearth of opportunities here in the U.S.
I'm sorry. In terms of what specifically? The landscape for acquisitions?
Yeah, if you were to put some of this money to work, I think the big question for investors is what is it going to take to get them off the sidelines? What it's going to take to get them excited about that next investment? What do you think his line of thinking is?
I mean, my sense is he's thinking that the economy in 2025, there's a lot of uncertainty. And I think there are a lot of people who share that view. I mean, the macro picture, the geopolitical picture has a lot of uncertainty, makes it very difficult to plan. And you've got equity valuations that, quite frankly, I think there are a number of us in this business that are a little surprised at how well they've held up, given all the risk, largely, stemming out of some of the actions in Washington. The other thing with Berkshire, too, though, to remember is 2025, they are going to be paying out at least $1.3 billion in wildfire claims. I think a lot of that's going to come from their reinsurance business. That number could grow. They have historically made estimates that end up being, lifted upward. But, if you look at typically where Buffett tends to make his outright purchases, he tends to have an equity portfolio barbelled between technology and financial, and that's barbelled largely because of the Apple position. And so his outright investments tend to be in energy, utility, consumer staples, insurance. I mean, I wouldn't be surprised if he decides to add on to some of his insurance franchises potentially. But if you look at the other areas where he tends to go into, the outlook is pretty uncertain. So it'll probably pay for him to wait. Historically, it has, and that's probably going to play out similarly this year.
And Kathy, just talking big picture here, because I think that's what a lot of investors like to glean from this, some of his commentary. What does it ultimately tell us just about market conditions then in the new year, and maybe what some of that volatility could potentially look like?
I think a lot of the volatility or how things are going to play out will really depend on the degree to which mass deportations ratchet up inflation, tariffs ratchet up inflation. And, Berkshire's biggest business is in insurance and reinsurance. And both of those policies are inflationary to the insurance business. So his core operating businesses are, sort of staring down the barrel of a gun with, potential threats to your operating margins. So, and then there's geopolitical risk. I think against that backdrop, he's probably going to stand pat and, coupled with the fact that he's being paid to wait.
All right, Kathy, always great to get your insights. Thanks so much for taking the time to join us here today.
Thanks.
Keep it right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell for you when we come back.
There you're taking a live look at the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq, where you've got Power Solutions International ringing the opening bell, PSI and some funfetti. And you've got Home Trust ringing the opening bell at the New York Stock Exchange. We are off into the races on this final full trading week of February. My gosh, folks, here we are. All right, taking a look at where we begin today's trading activity as we're taking a look at the Dow Jones Industrial Average. Let's populate this chart here for you and just give you a look at where the line graph is. There we are. All right, over the past 3 days, we've seen some slippage in the Dow, down by about 2.3%. Let's put this on a 5-day view so you can see the context of last week's move, 2.1% lower. Here today, out the gate, we are higher by about 0.3%. Nasdaq Composite, same there on a percentage basis, up by about 0.3%. However, the slippage late last week. As of right now, for the S&P 500, you're also seeing some gains over the course of the early trading seconds here that we have, up by about 0.3%. That's where we begin the trading activity, but coming off of last week's decline here that you saw of a little more than 1.3% over that past 5 days, according to the chart that we have up here. Ultimately, taking a look at some of the sector activity as well out of the gate. We'll get back to that NASDAQ board here, but more gainers than decliners here. Staples pulling up the caboose right now. That's down by about 0.3%. But taking a look at communication services, we begin the day higher by about 0.6% there. Like we said a moment ago here, more gainers than laggards right now for the 11 S&P 500 sectors. And digging into technology to start off today's activity, and want to take a look at a few key players here. Of course, the big earnings story of the week is going to be Nvidia. We're going to get that on the 26th. And taking a look at Nvidia shares here this morning, they're up by about 2.4%. However, some slippage that we have seen over the course of a few trading sessions here, and for Palantir, it continues. It's down right now, and it's breached back below that $100 level here. We are sitting right now lower by about 5.6% to start off today's trading activity. Just to give you a little bit more context on the move that we've seen over the past 5 days, if this chart would like to populate for me here, okay, it's not going to want to. But ultimately, over the past 5 days, I believe it's slippage of about 15%, just shy of that we have been tracking here very closely here. And then just lastly, we'll take a look at the Dow 30 components here. As we see mostly green here on the screen, there are some spots of red, but we'll kind of zero in on some of the mega cap tech stocks that are in the Dow at least, and you're seeing mostly green there. Walmart continues some slippage after its earnings last week. And ultimately saw that move lower here, and this is where you could see that earnings move plus today's activity moving it lower by about 0.5% here, down 9% over the past 5 days. Shauna, I'll toss it back over to you.
All right, Bradley. Well, let's talk about today's strategy sessions. Now time to dig into some of the moves that we're seeing here right at the open. U.S. stocks are rebounding today, coming off the S&P's worst sell-off this year in Friday's trade. However, the benchmark index has gone 35 trading sessions without back-to-back losses of 1%. So will the dip buyers return today and keep that momentum going? We want to bring in Michael O'Rourke. He's Jones Trading Chief Market Strategist. Michael, it's great to have you back here on the program. It certainly looks like the dip buyers are back. What are you gleaning from the early action that we're seeing this morning?
Yeah, I do think they're back today, but it's still early. I think Friday definitely spooked a lot of people as far as the economic data we received. There were dip buyers, I think, in the market Friday. There was some nice ETF inflows in the S&P 500 spiders and the other S&P 500 ETFs. But the volatility we saw Friday is something we haven't seen in quite some time. So it'll be interesting to see how this week plays out, especially with Nvidia's earnings later in the week. So
do you think it's safe to buy this dip going into Nvidia's earnings?
It's not that much of a dip, so that would be my concern. We hit all-time highs last week. I think it was Wednesday. Yep. So I think there's still a risk here that there's going to be more volatility that has to play out. And what you're seeing here is some of the names that have led the recent rally, whether it's Palantir, obviously some of the Mag 7 names. Nvidia had a massive bounce coming off of its DeepSeek lows. That you've seen some narrow leadership push us to those all-record highs. So I think we're due for at least some consolidation here. And I think you're going to see investors, while they'll buy the sharp downward moves like we saw Friday, I think if we see more of a slow leak or consolidation, I think you'll see people take a step back.
Michael, do you think Wall Street's a little bit too quick to dismiss some of the concerns still surrounding tariffs? And I guess what kind of volatility that could further introduce here in the weeks ahead?
Well, I think, it's funny when you guys were talking about the Robinhood new accounts and the big boost in their business earlier in the segment, that just highlights the way everyone's felt about the election, right? Since November, everyone's really piled into the market. Everyone's been very bullish, very optimistic. And I think, we have a long way to go for all these optimistic Trump policies to come into shape. It's one of those things where you do have to break some eggs to make an omelet. And I think we're going to be in the egg breaking stage for the next, 6 months to a year. So while we've had this early euphoria for the past 3 months or so, I think you're going to start to see that fade in the coming weeks and months as we try to see whether it's tariffs and other measures the administration's taking, while the market has to really digest those to see real progress somewhere down the line.
Well, for the price of eggs right now, it better be one damn good omelet, Michael. Ultimately, as we're thinking about moving forward from here, any type of recalculation that we're expecting off of this earnings period for the full year growth estimates as well here, have you seen that start to play out as we typically get some of those revisions early on, companies starting to step back off of some of the more aggressive outlooks that they have?
Well, yeah, I mean, I think you could definitely characterize this earnings season that's basically ending right now as somewhat disappointing. We're still looking at a good growth environment overall, but as we know, it's very top heavy, very much driven by the Mag 7. Obviously, the biggest driver of earnings growth the past couple of years has been Nvidia. So their report's going to be that much more important. But you're also looking at a situation where the Mag 7 is twice as expensive as the other 493 names in the S&P 500 together. So a big trend we've seen since, I'm going to say since Christmas, but especially since the beginning of the year, has been investors being a little more defensive, rotating into those other 493 names or the S&P 500 x the Mag 7, while you see the Mag 7 names consolidate a little bit. So like I said, I think we see those earnings growth numbers start to moderate here, but it's still expected to be a positive earnings year for the market.
Michael, I guess put NVIDIA's results into a little bit better context for the viewer here. How significant are the results that are coming out later this week in comparison to prior quarters? Does it still hold that same weight?
I think it does. Obviously, NVIDIA has been it has had one of the most remarkable ascents in the U.S. stock market because its business has grown fundamentally that well and that strong. From being a company that was doing, $15-20 billion in revenues, is going to do $120 billion in revenues in the matter of years, a couple of years. So that type of growth is really important going forward here. Now, of course, those growth rates are going to moderate, so that's important. But that type of change, that's why it grew to become the largest stock in the world, or largest market cap in the world. So it makes it very important. And of course, it's the cornerstone of the AI trade, right? Every major corporation is investing tens of billions, and especially hundreds of billions over the next couple of years into AI. And thus far, NVIDIA has been the primary beneficiary of that through their GPU sales. So again, it really is the pulse of where the growth is in the tech economy, which in a lot of cases is the U.S. economy at this point, and especially where the stock market earnings are and earnings growth is going forward. So I think it's as important as ever, basically.
Michael, thanks so much for taking the time here just after the opening bell. Appreciate it.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at the S&P 500's moves here. Hey, Maddie.
Hey, Brad, thanks so much. So it's really interesting to see the kind of bullish lean of this market, just biased towards optimism. We've had 35 trading sessions without a back-to-back drop of 1% so far this year, and that is the longest streak of moves in the S&P 500 to the upside without that back-to-back drop of 1% since last December. And over the past year, that's only happened 3 times. And this is interesting in the context of incoming policy from the Trump administration around tariffs in particular. This kind of known unknown in the market that's led to a lot of frustration and questions, but not an actual kind of drawdown in the market. Again, that bias towards optimism here. There are, however, signs that as investors continue to buy the dip, there is a question mark in the air. Steve Cohen saying, quote, negative for the first time in a while because of tariffs. Ken Griffin also having some bearish commentary on tariffs in the past week. And even Warren Buffett, of course, talking about some of the risks in the market here. I lastly just want to mention that while the broader index has moved to the upside here, the average S&P 500 stock has fallen as much as 9% this year. And Kevin Gordon over at Charles Schwab indicates that that could be indicative of a churn in the market, kind of some duck paddling under the surface despite smooth sailing above the water here, guys.
All right, Maddie, thanks so much for breaking that down. Well, with Nvidia coming up later this week, the company's earnings reports are going to be a huge focus here for Wall Street. Analysts expecting double-digit growth for both adjusted earnings per share and for revenue. Investors are waiting to hear what CEO Jensen Huang has to say about the environment for AI chip demand and potential rising competition in the space from China's DeepSeek. Yahoo Finance hit the streets of New York to ask everyday investors about how they're deploying their cash and whether or not Nvidia is part of their portfolio.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
The rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings reports of Nvidia. I think it's definitely going to be positive.
Oil prices slightly higher here this morning with the price of a West Texas intermediate WTI here briefly dipped below $70 a barrel. You're now seeing gains of just about 0.1%. The move here largely driven by some of the geopolitical uncertainty, supply risks. You have ING analysts citing a potential Russia-Ukraine peace deal and speculation about OPEC Plus production. Here with more is Ines for INS.
Yeah, Shauna, and we have seen various factors that are playing into the price of oil today, as you just mentioned. Of course, tariff uncertainty has really weighed on oil prices, has kept it sort of range bound for the month of February. But just to show you what we're seeing right now, we are seeing a slight move to the upside. As you mentioned, a push for a peace deal in Ukraine. This would normally move oil prices a lot lower, but I just got off the phone with an analyst that told me, look, the expectation is that sanctions, if there were a peace deal between Ukraine and Russia, sanctions against Russia would be lifted. But traders are saying that that oil is already hitting the market. So that's why you're not seeing a big move in oil prices. You also have Iraq that may add more supply into the market. And then you've got the expectations that OPEC Plus is going to once again delay its output, its introducing more barrels into the market. This would be the fourth delay for OPEC Plus. So traders are definitely looking at that and saying that there is a oversupply concern. There is one bullish factor for oil, and that is if the U.S. were to decide to refill its strategic reserve, that would more or less hold a floor price on oil. I do also want to note what's been happening with natural gas prices, because we have been seeing those tumbling down more than 6%. You've got warmer weather that's coming. There were some frozen wells. Now those are unfreezing and those wells are coming back online sooner than expected. So you could see natural gas production at its peak levels once again by the end of the week, guys.
Ines, thanks so much. Great context there. Appreciate it.
Thank you.
All your markets action ahead. Stay tuned. You're watching Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a closer look at some trending tickers this morning. We're doing it in 30 seconds each. Let's go. First up, Nike upgraded to buy from hold at Jefferies. The price target lifted to $115 a share. That's from $75 a share, implying 50% upside from the Friday close. Jefferies is bullish on a strong recovery over the next 2 years. The analyst sees CEO Elliott Hill prioritizing the restoration of wholesale partnerships and driving innovations. The firm also noting job listings for product positions are up so far this year versus the prior year. Quote, "We think Hill has the right playbook." The analyst also says Nike Skims will, quote, "revolutionize the activewear market." Shares are up 5%.
Let's take a look at Block. It was boosted to outperform from market perform at BMO. Now the analysts there are seeing an attractive buying opportunity following the recent underperformance. Shares are down more than 25% over the last 3 months. Now BMO's new price target implies a 30% upside as of Friday's close. The firm citing stronger profit growth for Square and also Cash App expected in the second half of 2025 as some catalysts here for the stock moving forward.
And finally, Twilio raised to overweight from equal weight at Morgan Stanley with a new price target of $160, up from $144 a share. That is a 40% increase from the stock's last close. The analyst says post-earnings sell-off was overdone, and the stock has fallen more than 20% since reporting Q4 results. The firm says that they are increasingly confident in Twilio's ability to execute growth margin reacceleration here. So those are some of the stocks that we're watching. But you know what? Since we've got some time and we're mic'd up and here on set already, let's go back to that Nike note for a hot second here, because some of the major things that they're also calling out within this playbook here also gave us some timing in the recovery that they're looking for. They're looking for a fiscal year 2027 V-shaped recovery here. Nike turning back on an innovation engine, inventory levels for their channels being rebalanced, and wholesale distribution, distro as they call it, being increasingly setting the stage for accelerating unit volumes and healthier full price sell-through. If you've been tracking at home, for Nike, what they've been talking about, the optimal scenario for them is this marker of selling somewhere around 65 to 70% of their product at full price. Now, it becomes harder to manage how much of that is sold at full price when you go through some of the wholesale and retail partnerships, because they have more of a need to get some of that inventory off of the shelves or off of the site so that they could bring in the new seasons of inventory that they're already in those purchasing conversations around as well.
Yeah, they talk about job listings, the fact that there's more job listings now for product, obviously really showing that that is an emphasis and a priority here for Elliott Hill. They talked about the fact that looking back 10 years ago, clearly the playbook worked then. They don't see it changing this time around. Very optimistic of that. The new deal that they announced with Skims, Nike Skims, are saying, quote, set to revolutionize the activewear market. So there is a lot to like within some of the changes that have already been made under Elliott Hill. And that very much seems to be just the thesis of this, the fact that we are seeing this return, obviously, to a focus on the product pipeline and ultimately what that is going to potentially do to drive some of those future sales. All right, well, that does it for a morning brief, but keep it right here on Yahoo Finance. Catalyst is coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we're going to break down today's market action as the stock market rebounding falters after the S&P's worst sell-off this year.
Plus, we hone in on the AI trade as investors await Nvidia results, and also Microsoft reportedly rethinking its data center needs.
And we look at how companies and countries are bracing for President Trump's tariff threats as Mexico and Canada return to the negotiating table, and Apple looks to add 20,000 additional U.S. jobs.
Let's do a check-in on the markets here, just 30 minutes into the trading day. And we're seeing a bit of a reversal of some of that buying action that we saw at the open. We certainly had a buy the dip mentality, at least it initially looked like. Although if you were listening to Michael O'Rourke of Jones Trading right at the open as we were speaking with him, he said we still have a long way to go and he wouldn't be reading into too much of those early moves. And he certainly has proven to be right, at least for right now. You are looking at the S&P now in negative territory. The Nasdaq actually off about 0.6%. You have the Dow trading just above the flat line. And I think as we look ahead to the next several sessions, obviously Nvidia results are going to be a clear indicator to some extent, obviously a potential market moving scenario results here that we're going to be getting later on this week. But I also think the fact that the behavior that we've seen off the back of earnings is certainly something to note here, because overall earnings season has remained very strong, yet there are some of these worries and risks that do tend to linger and are lingering within the market when it comes to some of the policies out of Washington. And that stifled some of that optimism, I think, so far.
And I feel like that's made it such a stock picker's market as well. When you think about the individual stocks leading to decreases of around 9%, but then you've got the overall index still moving to the upside and not tracking double-day digits of losses here. One thing I wanted to point out that we were talking about before the show, Shauna, this idea that we've got nearly 90% of companies already reporting this quarter. Fourth quarter profit growth of 12.8%. Expectations were just at 7.3%. So you've got nearly double the expectations when it comes to profit growth. So huge potential catalyst when you think about that. But then on the flip side, you've also got a potential catalyst with the bond market in terms of yields coming in and what that means for equities moving forward, whether we've got a stagflationary risk or a risk of growth shocks moving forward here off the back of those Trump administration policies is certainly something that we're going to continue to monitor here.
All right, well, let's talk about one of the potential catalysts here for the markets coming up later this week, and that is Nvidia. Nvidia is set to report fourth quarter results later this week. Wall Street seeing Nvidia profiting from the global build out of AI infrastructure, but still, it's one of the most cheaply valued AI stocks right now. He broke it all down in his brief over the weekend, and following this very closely, Yahoo Finance executive editor Brian Sazi. Brian, how should we be looking at the valuation of Nvidia?
It looks cheap. I went to the Yahoo Finance comparison tool, one of my favorite pages on our platform, and you can dial up various companies and compare them to Nvidia. And one multiple, you can see that chart right there. I made it easy for y'all, but I encourage you to go to the page nonetheless because it's really fun to play around with. You can look at the P multiple, 4P multiple on Nvidia, and you can see it is one of the cheapest, relatively speaking, on a PE basis versus other top AI names. Of course, that's ARM Holdings, you have Marvell there, you have Broadcom, ticker symbol AVGO. And I put this question out to folks on our Morning Brief newsletter on Sunday, getting a lot of really interesting responses since then. I'm going to put out a piece later this afternoon sharing some of those responses, the clean ones and the good ones, I should say. And I think this is what you're seeing. One, you're not seeing estimates or earnings per share estimates really rise for Nvidia at all. If you go into the Nvidia ticker page on Yahoo Finance, click on the left rail and click on analysis, and you can see the EPS trends at the bottom of the page. EPS estimates on Nvidia have not risen over the last 30, 60, or 90 days for the current fiscal year. And in fact, they have declined about 2 cents over the past 60 days for Nvidia for 2026, which I found very interesting. So in order for it to get a higher P multiple, you normally have to get earnings estimates on the street to rise. Now, the other component for the price to earnings multiple, at least in my view, is sentiment. And you have concerns about DeepSeek, you have concerns about AMD making advances on the chip front, you have concerns about Amazon starting to make its own chips, you have Apple starting to make its own chips. So maybe the street is has priced in some worries on Nvidia. I think for this PE multiple to catch up relative to other AI trades, Nvidia is going to have to come out and really do two things: blow away earnings estimates for the quarter later this week, and then come out in the first quarter or the current quarter and blow away estimates for that as well.
Yeah, Brent, I've read about the volatility aspect also over the weekend
Love your story.
when it comes to Nvidia and some of the behavior that we've been seeing in terms of the options market and maybe what that signals. And a lot of that has to do with maybe some of the growth concerns, how much of that has already been priced in. When you talk about the sell-off earlier this week when it comes to DeepSeek and maybe what that signals just in terms of how much of that has already been priced in and maybe that will just mitigate some of the volatility going forward. But again, when you write about Nvidia, just given the fact that it's been so important to the market, you do get a lot of feedback from our viewers just in terms of how we should be evaluating. And I think there is a lot of confusion out there just in terms of whether or not it is overpriced still, even though it is relatively cheap compared to some of those other AI trades.
Yeah, and I was thinking to ask you this, Brian. It seems like the market is both always happy and never happy because they're worried about Nvidia's valuation, but then when it comes down, well, is that a sign of a bearish signal for Nvidia that's not going to correct itself moving forward? So which one is it?
Well, let's be clear. If Nvidia comes out here and does not have good guidance and the earnings flow doesn't go well, Nvidia is still very, very owned by institutional managers all over the world. It's like their favorite company. So the broader market will be hurt. But look, I talked to Louis Navalier this morning on my opening bid podcast. He made a great point, and it's a very simple one. Nvidia is a monopoly. It's unstoppable. Now, I don't necessarily agree with Nvidia being a monopoly. There's AMD and there's other companies competing, but still, they are so far out in front of everyone. And while Nvidia's stock may trade at a discount relative to other AI names, the stock still trades at a relative premium to the S&P 500 at about 23 times. And that is a deserved premium. Nvidia over the next 2 years may grow earnings at about a 50% to 75% clip. So all in all, pretty good for Nvidia.
All right. Well, Brian, we're about to talk to an Nvidia bear about this, so it's going to be a great conversation.
Good luck with that
really.
one. I'm going to stick around and watch this.
I know. You're going to be our biggest fan. All right, Brian Sozzi, our own executive editor. Thank you so much. Like I said, our next guest still bearish on Nvidia, even as that valuation is coming in. Joining us now to discuss, we've got David Bahnsen, the Bahnsen Group's CIO. David, great to have you here. So you just heard us talking about these PE expectations coming in for Nvidia here, but you remain bearish, even though that valuation is starting to look a little bit more attractive. Walk me through your base case.
The valuation is not looking more attractive. Everything that was just said is about forward estimates that are wildly speculative. The fact of the matter is it's 58 times on a trailing 12 basis, which is how people have always looked at earnings multiples, not on what they expect it will do, but on what it has done. And if you compare its earnings multiple to some of the other AI companies, let alone other Mag 7 and of course other S&P names, it's at an incredible premium. Now, I agree it's earned it. I agree it's deserved it and generated the order flow. But one of the key things that was said, that, and your editor pushed back on what Louis Navalier said, it's just simply untrue that it's a monopoly. Nobody in their right mind thinks Nvidia is a monopoly. There's tons of competition, but all the earnings multiple estimates are based on them never having competition. They're running at a 56% net margin, where some competitors are at 12 and 15. I'm sorry, there's downward pressure coming on these margins, and the PE does not yet reflect it. I would not time a negative guess. This thing could go up far more, but it's completely dependent on greater fool theory of just a $3.3 trillion market cap getting a bunch of more momentum. That's the thesis for the stock, and it could play out for a while.
Yeah, David, and I think that's the question also amongst investors, right? It might not be a monopoly, but the moat that they have created, the competitive advantage that they do have, I think a lot of bulls would say that that then justifies the current valuation.
And again, the question is why the stock hasn't made a new high since July when the entire market's up substantially. And I think that the reason for this is that internal realization that the beauty of the technology story in America for years and years is that these margins come down over time. That you do not get to expand in infinity when there are real competitors. There's questions on order flow. There's questions on the utility of the very underlying thing being made. But the similarities, and I'm not saying identical, but similarities adjacent to what we saw with Juniper and Cisco in the late 1990s are absolutely uncanny. This is a phenomenal American success story that is substantially overpriced. And to grow right now 10%, which is not that big of a deal, you have to add a $300 billion market cap to what you already have. Basically add the size of a massive amount of the American economy just to get another 10%. That's the issue they're up against, is the law of large numbers.
Right, the growth expectations. And David, you make so many great points, but I wonder how you can kind of afford to be bearish big tech. And I want to pull up a chart here looking at, and I know you're going to have a great response to this, if I can have this chart here, looking at the S&P 500 tech names specifically versus income for the S&P 500 minus tech names. And you see a huge divergence in this chart where you're getting paid more to be in big tech. How do you afford to be out of it, even if your bearish stance makes sense to you?
Well, last year our dividend growth portfolio was up 23%, and the S&P was up 23%, and we owned 0 out of 7 S&P names. But in 2022, when the S&P was down 19 and big tech got walloped and Nasdaq down 30, we were up 6.5. So for a full market cycle, you can very much afford to be out of overvalued things. But there are periods where it can lag. I fully agree. This just isn't one of them. There's plenty of other things more attractive in the market than a 58 times stock that is already up 1,000% in a few years. So I'm not talking about the trade of Nvidia of a couple years ago. We're talking about the trade of Nvidia now. And I think that at least on a risk reward basis, people have to realize that they're buying something very expensive, hoping it gets more expensive. The way to be out of it is exactly what, by the way, investors have done so far these 8 weeks. 4 out of 7 names are down, and while the S&P's up and value's up more. Rotation happens all the time in this market, and I will suggest 2025 is going to look a lot more like 22 than the last year. That's my expectation based on where we are in the market cycle.
So David, let me put this to you. Should investors ignore the forward P on Nvidia and the hundreds of billions of dollars being spent on AI infrastructure by the hyperscalers?
Yes, because that is so priced in, they don't have to ignore it. It's already in the stock. So the issue, by the way, the forward multiple of Nvidia is not 29 times.
What is it?
It's 29 times if everything comes up perfect.
Why wouldn't
every batter on your
Why
baseball
wouldn't it come
team
on
hits
perfect?
a home run every
This is
single
a company
time they're up
that
and back.
essentially owns the AI chip space and is powering the Gen AI movement. Why wouldn't it come on perfect? What has Nvidia done the past 2 years, David, that would suggest they're not going to come out here and beat big this week and raise up their estimates for the first quarter?
They've done nothing the last couple of years other than the foolishness.
Well, then why does everybody on the street own the stock?
The foolishness of an investment thesis that suggests that what has happened the last couple of years always repeats itself.
So we don't need AI. We don't need AI chips from Nvidia.
Have learned the lesson against that the hard way.
So realistically, Intel is more of a value than Nvidia.
No, Intel is not. It's simply a story about valuation of a multiple. It's a story about order flow combined with valuation. There's two dynamics to what places a stock. It's both the fundamentals of the business combined with what you're paying for that story. People who ignore the latter have lost their shirts for years and years. Many of them learn it the hard way. Intel's story is not valuation. The reason it's broken is fundamentals.
So what you're saying essentially is that AI, what Nvidia is putting out, is not important to the world. And then you should wait, what, for the stock to correct 50% before you get an Nvidia?
I didn't say it's not important to the world. I said it's already priced in.
At 29 times forward earnings, even at 58 times.
It is not 29 times earnings. That is based on a sustenance of a 58% net margin and an 80% gross margin.
But who else is near Nvidia? Who else is doing what Nvidia is doing? They're expanding
margins.
That's
why nobody else is at $3.3 trillion market cap.
Well, then what do you think about Apple then?
I think that Apple is suffering in the same story. Why Apple's down a little bit this year too, because it's a huge success story that the good news is priced in. And if people think that Apple's next 10 years is going to go the same way as the last 10 years, then good luck to them. I would love to see that compounding of a $1,500 phone the way the last 10 years did. Nobody's saying anything negative about Nvidia or Apple over the past. Investors are making decisions today about the future.
10 years ago, Apple was expensive too. Look at it now.
No, it wasn't. It was 16 times. You're wrong. It was half the multiple it is now. Look it up.
David, I want to jump in here just to give our audience some actionable insights from your portfolio performance, because you talked about the outperformance of your portfolio despite the fact that you are not in some of those big tech names. Can you talk me through what your rubric for success of those non-tech names looks like and how you are thinking strategically about those picks? Any individual names you want to throw out as well?
Well, I think that in the last couple of years, there was an incredible opportunity in financials, and we just happened to do extremely well with dividend growers in the financial sector and then the midstream energy sector. I think midstream energy is still at extremely reasonable valuation based on yield spreads and all historical metrics. So I would heartily recommend continuing in the midstream energy sector. Upstream energy is a little less attractive, but I also believe that the financial side has plenty of value. But the things that lagged are now things that are catching up, which is some of the names in healthcare and pharma, consumer staples. These are great dividend growers. A lot of it depends on how severe the rotation is from growth to value type trend. We don't like to play it on a top-down basis, though. We're bottom-up stock pickers, which is why when you look at a fundamentally wonderful story of huge performance from some of these names like Microsoft, what they've done in the cloud, Nvidia with AI chips, Apple with a telephone. I mean, these are huge success stories, but we have to combine them with the forward free cash flow generation that's not already in the stock. And I think there's just a lot of great opportunity. And we measure this by one of the reasons we did so well with Broadcom. Broadcom is not the type of name we normally would buy, but their AI order flow became a significant competitor for Nvidia. And by the way, they were a huge dividend grower. We're at about 25% yield on cost on Broadcom, even though it's now down to a 1% yield. So I think you have to look at free cash flow right now, and I think you have to look at valuation. And I recognize a lot of people don't think you have to look at valuation. The good times are supposed to roll forever. History has just not been kind to that thinking.
All right, David Bonson, we always appreciate you playing along. Thanks so much for coming on here with us, Yahoo Finance. We look forward to continuing the conversation.
Thank you.
Coming up, we're going to be breaking down the debt ceiling's impact on the bond market. We've got that and much more, some of the biggest drivers of the market here as of late. Again, just about 45 minutes into the U.S. trading day, you are looking at stocks giving up some of their earlier gains here this morning. You have the Nasdaq under a decent amount of pressure here. We'll be right back.
Could the bond market be pricing in a growth slowdown? The 10-year yield has declined for 6 consecutive weeks and is currently trading at its lowest level this year after peaking just under 4.8%. Joining us in studio to discuss what's next for the market, we've got Tom Tzouris, Strategas Securities Head of Fixed Income Research. We also have Paul Eidelman, Russell Investments Chief Investment Strategist. Thank you guys for being here. Tom, I want to go to you first on these 6 weeks of consecutive moves to the downsides in yields, the longest stretch since 2019. what do you think the bond market is trying to tell us about growth versus any stagflation concerns?
Well, I think the bond market is trying to tell us that the U.S. economy temporarily is in a seasonal growth slowdown. That seems to be happening about every February and March. Credit card debt builds up, households pull back. We're in that seasonal slowdown now. We got some consumer sentiment numbers last week, which further indicated that consumer optimism is fading a bit. So the bond market's telling us that we're in a seasonal slowdown. But another thing that the bond market is telling us is that the fears of a trade war were deeply, vastly overblown earlier this year and late last year. And as reality is setting in, there's going to be eventually tariffs somewhere along the way, but it's not likely to be a full-blown trade war and one that has a prolonged impact on inflation. So you're seeing some of those fears recede. And I think the other factor that you're seeing right now, as of today, it's going to start to change in a few days as liquidity starts coming in. But another factor that you're seeing is that the market is also recognizing that there's not going to be any near-term deviation between the current Treasury and the prior Treasury in terms of their debt issuance schedule, which is also helping to ease some fears in the back end of the curve and push longer-term yields lower.
Paul, how does that compare to how the equity side of the equation has been looking at things?
Well, I think equities have a difficult setup here. Starting points in terms of valuations are pretty high. Policy uncertainty is pretty high, but I think it's important to focus on fundamentals too. And, you know, we're a good bit of the way through the fourth quarter earnings season now, and it's been very strong in the aggregate. The S&P 500 index is tracking 16% earnings growth at this stage. That's well ahead of consensus expectations going into the reporting season. And I think on top of that, we're starting to see earnings growth broaden out now. It's not just the Magnificent Seven stocks generating earnings growth. It's the 493. We're seeing financials back to positive earnings growth, and that broadening out from a fundamental perspective, I think, is a positive for equities for sort of the medium-term perspective.
What does that tell you about the Mag 7 names, though? Does that also, on the flip side, present a risk to some of those big tech names if the broadening goes too far?
I mean, there's always a risk. Those valuations are high, and the names have rallied very strongly, and so there's always the possibilities of volatility and pullback in those names. I think the more favorable scenario for equity markets going forward is that those names kind of plateau and generate more modest returns, and the rest of the market starts to catch up and outperform. And I think that's our central expectation for 2025.
Tom, when it comes to the likely action that we're going to see within the bond market, I guess how much of that risk has already been priced, and how should we be looking at the level as to where yields are today?
How much of the economic risk is priced in of, say, an economic slowdown? Mm-hmm. Not much. Yeah. So realistically, if we were to see any sort of recession, even a very shallow one, we'll call it a negative 0.5% to 1% GDP for 2 quarters, unemployment goes to 5%, you're probably looking at the Fed funds rate going down close to 3%. Which would suggest that the entire Treasury curve from 0 to 10 years is between 3 to 3.5%. So we're not pricing in any sort of even shallow slowdown in the U.S. economy.
It's interesting in the context of the Trump administration and Treasury Secretary Scott Bessent saying that if the moves we've seen in yields just continue, they'll get exactly what they want for the 10-year. Do you see the moves in the 10-year as a success story for this administration right now?
Well, as of right now, yes, because it could have been a lot worse. We'll gauge success 3 years from now when the Treasury has raised its coupon auctions and has not only financed future deficits, but has begun to scoop and toss those enormous amounts of Treasury bills that the prior Treasury pushed into the market ahead of the elections to kind of flatten the curve. If they can refinance those successfully without pushing 10s, forget about the 5%. If they can do it without pushing 10s to 6%, we'll consider it a success. There's a huge hurdle ahead for the current Treasury from a crisis that is not of their making. Right. And we'll judge success 3 years from now.
Paul, give us some insight just from the active manager side of things. I think investors are struggling with what to do at this point with their portfolio, given the uncertainty, given some of the headwinds and challenges that are out there right now. What would be your top advice that you're sharing?
Well, I think our money manager is looking for quality companies at a reasonable price right now, and they're trying to take on board all of this policy uncertainty and find where there's opportunities and good skew in the market. And what we're hearing is financials as a sort of standout sector and industry. One of the things that I think is quite clear right now at this stage with the new administration is that they are deregulating very quickly, particularly with the Consumer Financial Protection Bureau and other segments of the market. I think there's an expectation that we could have more M&A activity in 2025 that came through from some of the banks' results and guidance earlier in this reporting season. And so that's an area of the market that has underperformed, is trading cheaper and could benefit from both deregulation of the financial sector and more M&A activity from the sort of capital market side.
All right, Paul and Tom, we got to leave it there. Thank you so much. Appreciate it. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts.
Microsoft potentially canceling some leases for U.S. data centers. There was a new note out from analysts at TD Cowen raising those concerns this morning. The report raising concerns on whether Microsoft is in an oversupply position. Of course, the big takeaway from this is what that demand picture potentially looks like here going forward. If in fact these channel checks do prove to be true, and we are seeing Microsoft move back on some of these lease cancellations here over the next several quarters or several years. Again, I think overall this just begs it calls into question the amount of spending going on in AI right now when it comes to big tech. Maybe explains some of the pressure that we are seeing across the board when it comes to some of those larger tech giants here today. But again, some concerns about oversupply, concerns about demand here at this juncture because of the channel checks that were published in this TD Cowen report. Of course, could potentially be a focus here for investors. We asked Gil Loria about it from D.A. Davidson earlier on in the show, and he was saying it's a little bit too early to tell. But again, it's more we have to glean from the bigger picture. Nvidia will give us a good idea of what that demand essentially looks like here on Wednesday after the bell when they do report. But again, it is a market moving report that we're seeing this morning with shares off just about 2%.
It's interesting in the context of this complete and utter focus on exactly how much AI capex there is going to be. We did have Microsoft reiterating their plans for that $80 billion in capex, but they did not necessarily confirm or deny this note from this analyst over at TD Cowen on Microsoft canceling these leases from data centers. So as you said, Sean, I think the most important thing is that supply and demand duality here. There was this question for a lot of the big tech firms about whether or not they had an undersupply that was not allowing them to take advantage of all the demand that they had. And now so quickly it can just turn and lead to the opposite end of things where you have a question about whether or not there is going to be an issue on the other side when it comes to supply. And interesting in the context, too, again, of that huge focus on AI capex. And if Microsoft is continuing on that AI capex, is that enough if they're just transitioning where they allocate capital here instead of kind of any overturning of their data center.
Yeah, exactly. And I also think it's important to point out that within this report, they were quick to couch that they don't know exactly why this could potentially be occurring. They do bring up the question about the oversupply position. Obviously, that's one that we've discussed here. But again, there are lots of questions if this were in fact to be happening, just exactly what is the catalyst and why we are seeing that, whether or not it's indicative of something more broader.
Yeah, absolutely. Well, we're going to stick with Microsoft and what changes to AI data center plans could mean for the AI trade. Joining us now, we've got John Belton, Gabelli Funds Portfolio Manager and Managing Director for Growth Portfolios. John, great to have you here. So just want to get your initial reaction here to this feedback from this analyst, specifically when it comes to the rollback of these data centers. What do you think is happening there?
Well, I would first say I would strongly advise against, over extrapolating these channel checks. Not to take anything away from this analyst, and I'm sure that the things he's hearing are what he's hearing, but I think these are the types of checks that can be very, confusing to take out of context, or it's very important to take these in context. So are these leases that are being canceled that are net decremental to Microsoft's spending plans? Doesn't seem so based on what the company said this morning. They say there's absolutely no change in their data center spending plans. More than that, are these net decremental to industry-wide CapEx spend? Very unlikely. I think any change you're going to see in Microsoft's nearer-term CapEx spending are probably related to the change in relationship with OpenAI, meaning lower Microsoft CapEx spend would simply be higher Oracle CapEx spend. So I think those are the two first main points. And yeah, bigger picture, Microsoft said very clearly less than a month ago when they reported December quarter earnings that they're going to be supply constrained on the Azure AI services side of the business for at least the next couple quarters. So this is not a near-term impact to number. I think today's stock market reaction or response, sort of a continuation of a lot of the rotation we've been seeing the last couple days.
John, do you think results out from Nvidia are going to help alleviate some of these concerns?
Well, I think Nvidia should have pretty strong numbers. I think that's always healthy for the market to, go back to basics, go back to fundamentals, go back to numbers. I think Nvidia's report should provide the AI space, a sigh of relief that things really haven't changed for the worse. In fact, I think a lot of the fundamentals supporting the industry remain very much intact. But again, I think a lot of the, what's been happening in the Nasdaq the last couple of days, it's more market rotation. It's unwinding a lot of the performance, the outperformance to start the year, kind of resetting to reflect what is sort of a shakier macroeconomic and geopolitical backdrop.
And on the point of this note from TD Cowen, the real question it sort of boils down to is Microsoft going to have an oversupply problem? Do you see any evidence of that?
Definitely not near term. I think I have very strong conviction that is not going to be the case near term. All we heard over the last earnings cycle from the hyperscale companies, really from all technology companies, is the AI investment cycle is certainly continuing over the next year at least. I think there's a lot of optimism around some of the new AI services and applications that are coming to market this year. Very high conviction that data center CapEx, data center spending plans, especially in the near term, are not changing. And again, Microsoft is out this morning saying data center strategy has not changed. So I think these are channel checks that were probably taken way out of context. And that's not to say that there isn't a nugget of truth in them. I just think it's very hard to believe that a company of Microsoft's size, for something that's as sort of long lead time as data center planning, would have radically shifted its strategy in such a short period of time.
John, more broadly speaking, how are you looking at the relative underperformance or maybe muted performance that we've seen from many of these tech giants since the start of the year? Is there a catalyst that's on the horizon that's going to change all that if it's not Nvidia's results?
Well, I think I'd like to look at things on a longer term basis. So I think, sure, over the last week, the Mag 7 has come under pressure. I think year to date now, only one of the Mag 7 is positive. So yeah, tough start to the year. But what about over the last 12 months, over the last 24 months, over the last 60 months, or over the last 5 years? These stocks have been workhorses for any portfolio that's owned them. I don't necessarily see why that can't continue to be the case. I think valuations across this group are still pretty reasonable. Fundamentals, most importantly, are very strong across this group, Microsoft included. So, in terms of what catalyst can change things, that's, I think, very, very difficult to pin down. And trying to call the market near term in an environment like this is going to be tough. But I'm comfortable sticking with a lot of these names through this volatility.
John, is there one better position than the other of the group?
No, I just think they're all kind of case by case, all have different drivers, all have different dynamics. I still think Meta is a very interestingly positioned company. I think that's a business trading at a pretty reasonable valuation with, it's not hard to see, how they can unlock some pretty large untapped revenue pools in the future. I think they still have quite a bit of margin upside as well. So I think Meta is one that I continue to really like, and that one has hung in better than the rest of the group year to date. So.
All right, John, we're going to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
We'll have all your markets action ahead, so stick around for more. You're watching Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. It can all be done at Yahoo Finance's trending tickers page. First up, let's take a look at Strategy. It's formerly known as MicroStrategy. Looking at some losses here this morning, off nearly 5%. The company announcing that it's buying more than 20,000 Bitcoin worth nearly $2 billion. Now, the world's largest corporate Bitcoin holder, now nearing 500,000 Bitcoin. This is obviously nothing new from the playbook here of Michael Saylor. They've been buying Bitcoin nearly every single week dating back to October. Certainly they have been able to profit off some of that bullish momentum surrounding crypto ever since they started buying into this here as a hedge against inflation. You have seen crypto, Bitcoin specifically, rise just about 700%. So clearly benefiting off of that. We are seeing a bit of a give back here this morning, though. Shares off just about 5%. But again, sticking to the playbook that has, I guess you could say, has worked out for them.
It's so interesting when you take a look at the longer dated charts here, too, because over the past year, they're up 250 57%. Year to date, down 5%. So all of that buying and momentum that we saw lifting this stock to the upside following the election, potentially coming off of its steam just a little bit here. And I find that interesting in the context of a story you've already covered today, Shauna, about Robinhood and the SEC leaving its investigation of Robinhood behind. That follows the SEC doing the same thing with Coinbase. So I would have thought that would have led to a lift in some of these Bitcoin adjacent stocks, but looks like this morning we are seeing the opposite happening with MicroStrategy off about 4.5%. Next up, Starbucks eliminating about 7% of corporate jobs this week. As CEO Brian Niccol looks to deliver on his turnaround plan. Yahoo Finance's Brooke DePalma joining us now with more details on the layoffs. Brooke, what can you tell us?
Good morning. In a memo this morning from Brian Niccol to employees, he did inform the company as well as investors that there is going to be a layoff of 1,100 people beginning this week, and they will be notified by Tuesday, February 25th, tomorrow. Now, he said in this memo to employees that this really is intended to simplify the company's structure, operate more efficiently, increase accountability, reduce complexity, and drive better integration, all part of that back to Starbucks plan that is his key strategy as he really takes the helm now since September, with a focus on core coffee products, better pricing, and faster service. Now, beyond this layoffs, that's going to impact roughly 7% of its workforce. We also know that the company is asking vice president level and higher to return to the office at least 3 days a week, either in Seattle for U.S. employees or in Toronto for Canadian employees. Also important to note here, hiring for future employees, that's also going to be impacted. They will be expected to report to either Seattle or Toronto, and if they are, of course, hired and they're not part of that remote hybrid workforce, which will remain intact, just that they have to come in these cities.
Yeah, and Brooke, I think it also just illustrates just a tough macro environment that so many of these companies are up against right now. You also covered Domino's. They were out this morning, and a little bit of a different story there, but shares under a bit of pressure following some of those weaker than expected results.
Yeah, shares for Domino's fell as much as 6% this morning, and that was largely because of this ongoing pressure hitting the consumer, and also as well as this low-income consumer pulling back from their delivery service. So if you take a closer look at those numbers, earnings and revenue, they both missed Wall Street's high expectations. Food inflation did drive that revenue number higher, and they do expect that in 2025 that food basket is going to be up low single digits. They expect increases in the first half, then the second half, primarily driven by, interestingly enough, cheese prices. So keep a lookout for that. Now, their U.S. business did underperform. They noted that in-store pickups increased roughly 3%, but deliveries fell 1.4%. They did once again allude that to an impact on continued macro and competitive pressures that put pressure on that low-income consumer. Two other things to look out for here. Domino's executives touted on our earnings call with investors this morning that there still will be two forms of innovation. They kept closed lips on what exactly those innovations will be. Wall Street hoping that it's that stuffed crust pizza that has investors excited. Also, lots of investors looking out for that DoorDash partnership after they saw an increase of nearly 3% from Uber Eats. But they said that DoorDash partnership is going to be pushed out and won't happen just yet. So keep a lookout for that one.
All right, Brooke, thank you so much. Appreciate it. We'll have all your markets action ahead, so stay tuned for more. You're watching Catalysts.
Several government agencies telling federal workers to ignore an email from Doge that came out over the weekend demanding that they explain their work over the past week. Now on X, what you're looking at here, Elon Musk saying that failing to respond to this request, quote, would be taken as a resignation. Here with more on what this latest internal pushback means for Doge's cost-cutting campaign is Washington correspondent Ben Werschel. Ben, it's great to have you on. How should we read this? The one side, you might have Elon Musk just kind of doing it for some of the drama. And then you have President Trump over the weekend reiterating the fact that he wants Musk to get even more aggressive than he's been.
For sure, yeah. And then the third element here is that the email that went out on Saturday evening didn't say anything about firings. Musk tweeted what you put up on the screen there, but what the email actually said was just give us this by the end of Monday, and didn't talk at all about firings. And what I think is also leading to a lot of confusion here in Washington about this is that a lot of Trump's closest allies, their immediate response to this was to say, ignore this. Kash Patel was confirmed as the FBI director just a couple days ago, and the first major headline now that he's in office is him telling his workers, you don't have to respond to this. Similarly, at the department, the overseer of national intelligence, as well as the Department of Defense. So it's kind of led to this kind of, we don't really know exactly what this is. There's a kind of, but the overall mood music here for certain is that the question here, I think, among federal workers is kind of how far Musk is going to be able to go with this. There's no expectation that this is going to lead to mass firings at 12:01, but Musk is clearly kind of entering a new phase here as he goes from low-hanging fruit, contracts that he can just kind of cancel unilaterally, probationary workers who enjoy a lot less legal protections, to longer-term government workers who have more protections, and I think are clearly in the target here. So we have this deadline of tonight. There's a lot of unclarity on what it is, and whether or not this feels itself out in the next couple of days. It's clearly going into these workers' files. That's the sense I get, and then they're going to be, as Musk gets to their department, do they respond to this or not becomes a question.
Well, all of this cost-cutting, Ben, also comes ahead of House Republicans set to vote on that $4.5 trillion tax cut and reconciliation bill this week. What do you expect from that?
For sure, yeah. This is the make or break kind of first step for taxes this week. Mike Johnson and the House Ways and Means Chairman Jason Smith have really pushed this kind of idea of one big, beautiful bill, and Donald Trump has endorsed it. So, but the question is, he has a lot of problems with this. Here's some quick numbers for you. This is $1.5 trillion in spending cuts, $4.5 trillion in tax cuts, which equals about $3 trillion in possible red ink. Johnson sort of has problems on all sides of this. A lot of these cuts, especially ones to Medicare, are ones lawmakers got a whole earful about last week when they were home in their district. $3 trillion in new red ink is a big problem for real fiscal hawks, and then that doesn't even get to taxes, which $4.5 trillion, believe it or not, is low amongst some of what they want. I've calculated Trump's various tax promises. He's made somewhere in the neighborhood of 16 to 17 different tax promises, both this year and last year if you count the campaign. And $4.5 trillion could not even cover the first one of that, which is fully extending his Tax Cuts and Jobs Act from 2017. So this, believe it or not, this is going to be a really hard week to kind of get this through and see if we're going to get a tax bill now. But it could actually be the easy part, because the actual tax negotiations, whenever they come, will be even tougher. And what we will learn this week is kind of the shape of the tax bill, but we'll also get a sense of what the government shutdown fight, which, believe it or not, is in 18 days. The government could shut down in 18 days, as well as the debt ceiling, which is also entwined in this in a lot of ways.
All right, Ben, got to leave it there. Thank you so much.
Sure thing.
Mexico and Canada have reportedly intensified discussions this week in an effort to avoid tariffs as that March 4th deadline looms. This comes as Canada's 6 big banks are expected to build reserves to offset potential tariffs, according to Reuters. We got Heidi Kribo-Redeker, a senior fellow at the Council on Foreign Relations. She also served in the Obama administration as the State Department's chief economist, here to discuss. Heidi, let's start on Canada building these reserves. Help walk our audience through the potential economic impact of a move like that, and do you foresee other countries following suit?
So, I mean, as you mentioned, the clock is ticking on a number of fronts. Mexico and Canada, obviously, coming up in a matter of the next week, and you have companies that are front loading purchases and trying to make sure that they can actually be prepared in case that Trump decides to actually impose the 25% tariffs on both Mexico and Canada. But the negotiation, you have to remember, this is about leverage and leverage for illegal immigration and for stemming the flow of fentanyl. So it's I think Canada and Mexico can do quite a bit on the non-tariff side, on the to actually make sure that they do not have these tariffs actually go into effect on the March 4th.
Heidi, there was a recent Bain survey, and they spoke to COOs, top executives, asking them just about the potential impact of these tariffs on their business. And they found that 40% of those COOs and top executives are anticipating double-digit increases to input costs due to some of the tariffs that have been threatened from the White House. I guess, what is your assessment of some of those broader economic implications and ultimately how this could potentially slow some of the growth that we are seeing in the U.S. economy?
So I fall into the camp that thinks that this is actually very much going to be inflationary and could hit growth. I don't think that we have an administration that fully appreciates the supply chain shock that would come on imposing the 25% tariffs, particularly on Canada and Mexico. So companies should be worried about this, but it's also going to be one of those moving targets. Right now, we really only have the 10% across the board on China. We have, an April 1st deadline coming up on reciprocal tariffs, which I think is actually potentially extremely disruptive because no one really understands how the Commerce and USTR are going to calculate, including VAT and currency and potentially digital services taxes, and go product by product. I think this is for a customs officer, this is a nightmare, and in trying to actually figure out who should be charged what. And again, all of the payments, you have to keep reminding yourself, it's the U.S. customer that is paying the tariff, whether it's for intermediate products or for end products.
So then, Heidi, what's the ultimate fallout just in terms of U.S. competitiveness, what it means for innovation here in the U.S.?
So I think, we've seen over the past 4 years, actually, post-COVID, many companies around the world taking a China plus one strategy because they wanted to make sure that they could insulate themselves from shocks coming out of China. I think we might see sort of in a sort of 30,000-foot companies looking to do a U.S. plus one strategy right now. The U.S. is obviously a market that is, you have to be in the U.S., but more and more countries actually have China as their number one trading partner. And if you're going to have your best friends, if you're sitting in Canada and your closest ally to the south is actually threatening you with tariffs, you're going to look at ways to diversify to cut your vulnerability. And I think that is overall long-term strategically negative for the United States.
Heidi, I want to switch gears a little bit and ask you about this email that Elon Musk sent out to federal employees last week. As someone who worked at the State Department yourself, how are you digesting the idea of an email like that? When you were at the State Department, what would you have done if you got an email asking you to outline the work that you'd done in the prior week?
So I think that the response of the State Department was appropriate, and same thing with the FBI, with the Department of Defense. Really, this is something where it's not. I couldn't have disclosed a lot of the things that I was working on because they were confidential and wouldn't be limited to 5 bullet points. So I think it is good that there is some pushback from the agencies themselves because this is obviously unprecedented and think what you might about Doge and their objectives, but the way that they're actually implementing this is really it's really questionable.
All right, Heidi, always great to have you. Thanks so much for joining us here with your insight. Heidi Kribo-Redeker, thanks.
Thank you so much.
Well, coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Howell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks are lower this morning. It's after an earlier attempt to recover from Friday's sell-off failed. Apple announcing it's going to spend more than $500 billion in the U.S. over the next 4 years. Investments will include a new factory in Texas and 20,000 new jobs. And TD Cowen analysts saying Microsoft has canceled contracts for several AI data centers. That report sparking concern of oversupply. And Palantir shares continuing to plunge after suffering their worst 3-day stretch since 2022. News of hefty Pentagon budget cuts sparking fears of revenue concerns for the company. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More wealth when we return.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In. We discuss the number one thing investors need to know to make good buying and selling decisions. And more chaos at Doge. Federal workers have until midnight to explain what they've achieved last week or face being laid off. We discuss how the layoffs could expand beyond Washington and give people with layoff anxiety some actionable tips. Plus, Warren Buffett released Berkshire Hathaway's 2024 annual letter to shareholders. We discuss the results and break down Buffett's wealth. All that and much more coming up during today's show. But first, we take a look at some of the market action 90 minutes into the trading day here. And we are mixed right now. We're seeing some slippage, though, from where we began the day. Stocks continuing to slide after Friday's sell-off. Investors looking ahead to fresh inflation data out this week. Joining me now with more, we've got George Cipollone, who is the Penn Mutual Asset Management Portfolio Manager. George, good to have you back on the program with us. You say the most important thing for investors right now is to know your fundamentals. Explain what you mean by that.
All right, Brad, great to see you again. And so my favorite quarterback right now is the Philadelphia Eagles, Jalen Hurts, and he always says, keep the main thing the main thing. And what that means for us as investors is to make sure you know your fundamentals, why your stock is going up. And so if you think about how a stock goes up, there's really three main components. It's your valuation, your sales growth, and your sales performance, and your margins. And most people lose track of that over time. They tend to just look at the price, but that price means something. And underlying, it means a lot. And let's just take Walmart, for example, that reported last week. They reported great earnings, but their PE was at 42 times. And so, again, you have to know why your stock is up and what components move that stock price up. And again, it all goes back to the fundamentals.
And so, number one, love the answer to the question here. And there is a lot that's intertwined within that, as well as my Eagles fandom there. So I appreciate that. And yours as well, I can see. But as we're thinking about building a portfolio, what is the number one thing that people need to keep in mind as they're keeping the main thing, and trying to understand how other stocks that they own within that portfolio or assets they own within that portfolio can move based on headlines out of DC or headlines off of an earnings bellwether like Nvidia that's coming out this week?
You're right, Brad. And so there's a lot to handle, especially as an individual investor. Number one, I'm always a proponent of or an advocate of active management because that's what we do. And I think that's pretty important. So if you have good managers that can help guide you through that. The other thing is to obviously know your risk tolerance, to know what we almost say sometimes, especially as value investors, you almost have to choose your suffering, right? Because, our stocks have been left behind by these growth stocks over a number of years. But now we've seen a pretty big cycle rotation away from growth. If you look at the Mag 7 stocks, I think Apple has had a 5% drawdown. Tesla's had a 30% drawdown. These are some massive swings. You have to know as an investor if you can handle those swings and if you can still invest over time. Peter Lynch said the best way to do it is to just add a little bit every month, right? And keep buying. So, but you have to know your risk tolerance. You have to know, again, you're not going to know everything about the market as an individual investor. So you can rely on maybe some good managers on that other side of it. But again, knowing your risk tolerance is really important. People tend to make bad decisions when they're losing money.
How do you build a margin of safety into your portfolio?
It's important. So there's a couple different ways. Number one, the easiest answer is to just hold some excess liquidity, hold some cash. There's, if you look at Buffett's portfolio, for example, I think he has roughly 27% in cash right now, or T-bills, which is the most he's had in a very long time. That's one way to do it, broadly speaking. The other way to do it is on an individual sector or stock selection basis. So one of the things we like to build into each company that we buy is a little bit of a buffer. So that can be financial liquidity on the balance sheet of a company. So maybe if they have more cash than debt, for example, you don't have to worry about interest rates if they have more cash than debt. Or if you look about their margins, how sustainable have they been through a full market cycle? Again, these are very idiosyncratic. They're very specific to a company, but it is important, and you can build in margin of safety both through security selection and then again more broadly with cash.
How should investors be aptly navigating this environment right now where the Fed essentially has kind of taken the back seat, as we're not expecting to get a decision until later this year about not a decision about rate cuts. Of course, they'll have their meetings for the FOMC, but they're not expected to roll out a rate cut until later this year.
Yeah, Brad, it's a great point, because if we came into this year and you told me that by February we're not concerned about, or the Fed might be the fifth on the list of major concerns, we all would have been surprised, I think. So right now we are in a period of incredible uncertainty. The market's valuations, I think, are expensive on 19 of 20 factors, and now you have massive changes in policy. You have not just individual investors concerned, you have companies concerned. So one of the things we like to listen to are the commentary from Ford's GM, for example, who's very concerned about the profit hit from tariffs. And then if you look even further, the threat of stagflation might be here, where the University of Michigan study just came out, or survey came out, and people are expecting inflation to stick around for a while. And that's different too. So again, there's a lot of moving parts. Going back to the margin of safety issue, it's okay sometimes to be cautious as an investor, and it's okay to be risky from a certain standpoint. And you have to kind of pick and choose sometimes when is time to go on and when there is a time to kind of take a step back. And I think right now, with all this uncertainty, it's okay to take a step back, maybe look for some safer alternatives to stocks, and then just see what happens.
George, great insights as always. Thanks so much for taking the time here with us today.
Thanks, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills here on set. Maddie, we got to talk about European food delivery giant Just Eat Takeaway, set to be acquired by Dutch technology investor Prosus in an all-cash deal worth about $4.3 billion. The deal is set to create the world's fourth largest food delivery company by gross transaction value. Look at the reaction in the shares today, Maddie, up 53%.
Huge. You can see that's a 52-week high for this stock, especially after Just Eat has had a lot of issues. In Europe, following the pandemic, there was an initial huge bump in a lot of these food delivery names like Takeaway's stock. But following the depths of the pandemic, it was hard for those companies to kind of hold on to those gains. And we saw Just Eat even selling its Grubhub arm at a significant loss. And that was one of the many challenges they faced over that time period. Now you've got the Prosus CEO saying he wants to create a European tech leader by combining Just Eat's market presence with Prosus's investment experience. And that's exactly what you're seeing playing out in the stock action. You've got this stock. It was up nearly 55% earlier, as I mentioned, hitting that 52-week high. A little bit of a different story when it comes to Prosus, down nearly 7%, perhaps an idea that they're paying a little bit too much for this all-cash deal, about $4.3 billion there. That values Just Eat shares at about £20 each, and that would be a 63% premium based on where the share price was when the deal was announced, Brad.
Absolutely. Massive move that we're seeing here on the day. We'll continue to track that. Plus, we're also tracking this big slipper, if you will, PLTR, continuing its decline, seeing its biggest four-day drop since 2022 as Defense Secretary Pete Hegseth plans to reduce projected military spending by 8% over the next 5 years. Hegseth set today as the deadline for input on proposed cuts. Palantir down by 9.6% right now here, and we've seen a large amount of the defensive stocks taking a hit on some of these announcements too.
And I just took a look as you you said that where this stock stands in the eyes of investors here. We've seen a lot of analysts changing their ratings on this stock over the last couple of weeks here. You've got over half of Wall Street having a hold on this stock. You've only got about 24% having buys. So certainly some bearishness, or at least kind of holdness spreading out for this stock here as investors kind of extrapolate what the U.S. military's defense spending cuts might look like. Again, Defense Secretary Pete Hegseth saying that they're going to cut military spending by 8% over the next 5 years, which could put a key revenue source for Palantir into question here. It still had an incredible run here, right? Up over 300% in the past year. If you take a look at a lot of websites other than Yahoo Finance, you will not see Palantir show up in the best performers in the S&P 500 because it was just added to the S&P over the last year, but it is included in the Yahoo Finance platform. So you'll be able to see that that is one of the top 10 performers despite the recent dip in Palantir.
Even with this pullback, still up 22% year to date here. Of course, the gains were much larger after the earnings we had seen. And even kind of 2 weeks ago, we were taking a look at year to date move higher by about 60% at the highs that we had seen. So we're going to continue to track PLTR as well as the other industry related names as well. And we're firing up the form submission for holdness to go into Merriam-Webster's.
Yes, thank you.
Well.
That
Love
was tough.
I'm putting that on a t-shirt. No, you're good. Maddie, thanks so much. Appreciate it. Nvidia reports fourth quarter earnings Wednesday after the closing bell. Analysts expect double-digit growth for both adjusted earnings per share and revenue. Investors waiting to hear what CEO Jensen Huang says about the environment for AI chip demand and potential rising competition in the space from China's DeepSeek. Yahoo Finance hit the streets of New York City to ask everyday investors about how they're deploying their cash and whether or not Nvidia is part of their portfolio. Take a listen.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings report of Nvidia. I think it's definitely going to be positive.
Elon Musk is telling government workers they have until midnight to detail their accomplishments from their last work week or risk losing their jobs. The head of President Trump's Department of Government Efficiency posting on X over the weekend that all federal employees would soon receive an email with those instructions. This is the latest escalation in Trump's plans to reduce the federal workforce. While many might think these layoffs are exclusive to the nation's capital, the majority of federal workforce actually lives outside the capital and its surrounding communities. Here with more, we've got Yahoo Finance senior columnist Jenna Herron. Hey, Jenna, what do we know?
Hi, Brad. So just under a quarter of the about 2 million federal civilian workers are located in D.C., Maryland, and Virginia, but that means the remaining, which is almost like 75%, live in the rest of the U.S. and its territories. And this is not counting post office workers and members of the military, by the way. And in some of these locales outside the D.C. metro area, federal workers can account for 5 to 7% of the area's total employed population, which is a pretty meaningful amount. A lot of these areas are home to one or multiple military bases, which employ hundreds, if not thousands, of civilian workers who support the base's operations. A good example that I found was in Colorado District 5, which includes both the city of Colorado Springs and several large military installations. And there, federal employees make up 6% of the district's total workforce, and there are about 13,000 of these workers in the Colorado Springs region. The people I spoke to on the ground in Colorado Springs last week said they had not heard of any layoffs yet, but it seems from reports that the Defense Department is set to fire thousands of probationary workers this week. We've also heard of layoffs among the National Park Service, which affects many federal workers outside of that DC metro area. National parks are also a big source of tourism income for many local economies. Take, for example, North Carolina's District 3, which includes the bulk of the Outer Banks region and is home to 4 national parks. So not only do federal workers make up 6.5% of the district's workforce, but the parks together generated almost $1 billion in economic output in 2023 and supported more than 11,000 jobs in the total area. Another example of how the federal workforce contributes to communities across the country is the IRS, tax season time. One of the IRS hubs is in Kansas City and employs 16,000 workers, and that's of the 30,000 federal workers in that metro area. One expert I spoke to in Kansas City said if the federal workforce is cut by 10% there, which is kind of the target that's been bandied about by the Trump administration, that would be 3,000 job losses in Kansas City. And right now, there aren't 3,000 jobs available in Kansas City for people with bachelor's degrees or higher. So I think that really shows how crucial these jobs are to many communities around the country.
Yeah, major economic, community consideration, as well as employment situation that we're going to continue to track here. Jana, thanks so much for breaking this down.
Thank you.
More than 8 in 10 workers are worried about losing their jobs this year, according to a recent survey from My Perfect Resume, and they're not wrong to be concerned. Roughly 4 in 10 companies worldwide expect to reduce their workforces over the next 5 years due to AI's increasing capability, according to a report from the World Economic Forum. So we want to bring viewers some help with what to do if you're struggling with job layoff anxiety. Here with 5 ways to proactively brace for a job loss is Yahoo Finance senior columnist Carrie Hannon. Carrie, this is a big topic. The first 2 that you list have to do with your savings and self-care. Tell us about those.
Yeah, Brad, I think when we are in moments like this, we feel out of control. And one thing that you can do is while you're still getting a paycheck, okay, nothing's happened to you yet, take control of your spending. This is a great time to see where can you get lean and mean, where can you trim back, and get that emergency savings account pumped up. You want anywhere from 6 months to a year, if that's at all possible, of your monthly living expenses set aside in an emergency fund, because it could take up to 20 weeks. The average time to get a job for someone is 20 weeks these days. So be prepared financially. Number 2, take care of yourself. You can't move into a job search unless you've gotten yourself in a good space. So what I'm talking about here is, exercise, take some walks, get out in nature, do mindful meditation, whatever's going to work for you. But take the time, maybe it's journaling, but take care of yourself.
And after you've saved and gotten in a better headspace, you probably need to get down to searching for a new job. What can you do?
Yeah. Let's get to basics, Brad. This is actually anyone should have a plan B of what they might do if this were to happen. But number 1 is network. I like to say networking is 1 letter away from not working. So reach out to people you want to, stay in touch with your industry groups, things like that. And just be curious about what might be available out there, what openings. And polish up your resume and your online presence. Do these little tweaks. Now, you have to be careful, it's a little tricky here because you don't want anyone in your job that you have right now to think you're job searching, right? So keep it under wraps a bit. But this is your time to take action, because nothing is going to make you feel better and deal with the anxiety that you're feeling right now than doing something proactive. And, add to your skill sets. We should all be doing this anyway, but it might be a good time right now to just tweak and add something to your wheelhouse a bit to make you even more attractive to employers moving forward. So I think those are the most important things. One thing you could do is a little side hustle. muscle, but that's really asking a lot. So not everyone's going to do that. But just lay that groundwork just in case so that you're prepared.
Carrie, thanks so much for breaking this down. Really appreciate it.
Thanks, Brad.
Coming up, understanding value investing, what you need to know next on Wealth. Billionaire Warren Buffett is known as the most famous value investor today. Benjamin Graham, known as the father of value investing and author of The Intelligent Investor, was one of Buffett's teachers at Columbia Business School. But let's back up here. What exactly is value investing? It's an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. This involves picking stocks that are priced lower than what you believe they are worth, stocks that are undervalued by the market. So, investors hope to capitalize on buying an undervalued stock low in order to profit when it rises. But how do you measure what stocks are undervalued? There are several ways. Here are a few. Price to book, or PB, measures the value of a company's assets compared to the stock price. If the stock is lower than the value of the assets, the stock is undervalued. Price to earnings, or PE, shows the company's record for earnings to determine if the stock price is not reflecting all of the earnings or is undervalued. And there's also free cash flow, the cash generated from a company's revenue or operations after costs of expenditures have been subtracted. Overall, value investing is about the long-term game. It's not about chasing trends or timing the market. It's about recognizing the worth of companies and waiting to buy them at a discount in order to eventually, hopefully, profit when the market catches up. In his 2024 annual letter to shareholders, Warren Buffett defended Berkshire Hathaway's growing cash pile and also reflected on mistakes made around the economics of different businesses. Buffett said the company did better than he expected, but our next guest says Buffett's musings and that $334 billion cash position is bearish for Buffett. Here to react, we've got Bill Smead, who is the Chief Investment Officer at Smead Capital Management. Bill, always a great pleasure to get your read in on Buffett. Break down your analysis of this $334 billion cash pile that they've accumulated.
Well, the first thing is he said there's nothing compelling. In 1969, when he broke up his partnership, he said the kind of things he likes to buy had been combed and recombed. And then a year and a half ago, he said the kind of large, wide moat, high quality companies with high return on equity that they like to buy have been endlessly picked over. So he's gone combed to recombed, endlessly picked over, nothing compelling. I don't know how many languages or vocabulary breakdowns you need. The $334 billion in cash tells you everything you need to know. He's as bearish as he ever gets, and I don't think really wants to offend people at this time.
You know, some would call that cash pile dry powder, just waiting to be deployed. Where do you think some of the first areas are that he's monitoring for to ultimately redeploy some of that cash?
Well, for him to put a lot of that cash to work, he would need 07 to 09 or 2000 to 2003 bear market. And by the way, that wouldn't be the most shocking thing from here that ever happened. I think Buffett's favorite measuring tool is the stock market value versus GDP, and it's the highest it's ever been. So if he was worried about it in 2000 when it got high, just imagine how worried about it he would be right now.
And so if you were sitting on that cash pile, where would you be deploying that right now?
Well, there's a couple things he likes to do. We own one company that would be the kind of thing that he likes to do, which is D.R. Horton, which is 7% owned by the heirs of D.R. Horton, who passed away last year. Now, I'm just using this as an example. A family-owned public company, as an exit strategy, a lot of time we'll call Buffett, like Clayton Homes or others, and just say, hey, would you keep everybody in place and let us join your party? But that's just an example of what might happen. The home builders have kind of been left for dead here as people worry about the affordability of homes, despite the fact that the largest home builders, Horton and Lennar, actually alleviate that problem by building affordable homes. D.R. Horton builds the most affordable brand new home in all 36 states they operate in.
You know, all of these things considered, for the positions that they're still holding on to, do you think that we'll ever see a Buffett, the activist, in those positions where they still do want to have a voice in their shares and through their voting value as well?
Well, I think the baton is being passed to Greg Abel. And some pretty reliable sources indicate that he's a very strong business selector. But I don't care whether it's Greg Abel or whether it's Todd Combs and Ted Weschler. This is a difficult market to navigate right now for people looking for value. We find value in the oil business. We find value in the home builders. We find value in some of the out of favor pharmaceutical and biotech companies that people are afraid to buy because of the political climate and the newfound job for Mr. Kennedy. That's where the bargains are right now. And of course, people are scared to death to go there, that's a key to value investing. In The Intelligent Investor, Ben Graham said, the value investor buys from pessimists and sells to optimists.
Bill, always a pleasure to grab some time with you. Thanks so much for breaking down the latest findings from Berkshire Hathaway as well.
Thank you.
Berkshire Hathaway is now the 9th largest company in the world by market cap at just over $1 trillion. It was originally founded in 1839 as a textile manufacturing firm. It later merged with other companies to become Berkshire Hathaway as we know it today. Warren Buffett began buying shares in 1962 and took over in 1965. There are two share classes of Berkshire Hathaway. Class A, introduced in 1996. The shares Buffett originally owned were converted to this class. They are currently priced at more than $700,000 per share, thus creating the need for a more affordable version, the Class B shares. Buffett is the 9th richest person alive, according to Bloomberg's Billionaires Index. He has a net worth of $150 billion, trailing other big tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos. The majority of Buffett's wealth comes from his 37% stake in Berkshire Hathaway. That shakes out to over 207,000 shares of Class A and B, worth around $148 billion combined. He also has $1.7 billion in cash and other assets. And in 2025 alone, Buffett's net worth has grown by $8 billion. Coming up, investing in gold. Is now the time to buy in? We've got everything that you need to know next on Wealth. So far in 2025, gold has significantly outperformed the broader market index as market investors right now flock to the safe haven. For those looking to add gold to their portfolio, is it too late to buy in? Joining me now to discuss, we've got Bobby IXIC, Path Trading Partners, Chief Market Strategist and co-host of the Futures Edge podcast. Bob, always a great pleasure to grab some time with you. First, let's answer that question. Is it too late?
Well, I'll say this. It's not necessarily too late. I just know there's going to be a clear signal as when the turn is going to come. Whenever something has gone as far as gold has, we talked about buying it in November of 2022, and it's obviously outperformed literally for 2 consecutive years. If you exclude dividend, 1 year, including dividends, gold outperformed the S&P. And in terms of just raw returns, it outperformed the Nasdaq as well last year. The issue is that there's 3 regimes that are possible right now in the overall economy, and that's stagflation, recession, and reflation. Gold can perform well in all 3 of those. Stagflation, gold performs well. Recession, gold performs well. I think we're in a reflationary environment, meaning a resumption of inflation, but the Fed hasn't quite addressed that yet. And so when the Fed starts addressing that gold is doing what I see it doing, which is resuming its move into the higher stratosphere, then that's probably a time where it becomes too late. Because once the Fed is fighting inflation, that's when the so-called inflation hedge that a lot of people think gold is starts to expire.
And so where are we within the correlation of gold as an inflation hedge as we speak right now?
So a lot of things people don't realize, gold is an asset, just like stocks, just like your homes. And with inflation comes asset inflation. So when you're seeing inflation, you're seeing prices reflate. That applies to your home. It applies to stocks that you may own. It applies to a car you may resell, as we saw in used car prices recently. So gold is an asset that fits in that as well. It becomes an issue when you see the Fed start to fight inflation. And by the way, it becomes an issue in all assets again. If you all of a sudden see the Fed switch from this sort of we can pause on policy and wait, or if you look at the CME Fed Watch tool and you go to the probabilities tab, the market's still pricing in cuts. They're not even pricing in neutrality over the next 2 years. They're pricing in 2 more cuts. As soon as that goes away and it moves to 2 more hikes, or the Fed, in the form of Fed Chair Jerome Powell, of course, starts to talk about the idea that hikes may be the next probable move by the Fed, that's when you're likely to see all assets start to deteriorate a little bit. Gold is going to be a part of that and probably one of the early movers.
And so for people that are not buying gold specifically as the asset, we also saw last week gold-backed ETFs as an asset saw the biggest net inflows since 2022. Are ETFs the smartest way to hold gold in the portfolio?
Not in my opinion. So we have micro gold futures at the CME Group. If you're familiar with futures, if you're able to trade futures, if you're familiar with the roles of futures contracts when they expire, that's really the best way to invest. Again, micro gold futures, really, it's the pricing mechanism even for ETFs. When you see the Spider Gold ETF go through, they're usually pricing to the gold future. Having said that, a lot of people are nervous about futures. They don't understand the mechanisms of them. GLD is the best one then, because in that particular case, you're seeing something that mirrors gold the best. There's a lot of gold ETFs out there. GLD has the most assets for a very good reason. Then, of course, you can buy physical gold. There's several reputable gold dealers. There's also several unreputable gold dealers. I don't want to call them anything worse than that. So you just kind of have to do your research to buy physical gold, find the proper storage, or even store it in your own home. If you have physical gold, it is actually a liquid asset, more so than some of these other things we've discussed.
And so all of this in mind, is this still the best metal versus the others, especially given the run-up that we've seen in gold?
It is to me. So industrial metals have specific use cases. For example, copper had a really big run when the administration was pushing EVs as an inevitability because there's a lot of copper in electric vehicles. That's kind of shifted with the administration that we have now. So you see a little bit of weakness in copper. Gold is standard. You're just looking at inflation and whether the Fed is fighting it or not. Those are really the variables for gold. You can even use the dollar as a proxy for that. So gold is the best bet in my view. And I think a lot of people should have gold over the long term because there's one more advantage to gold that we haven't talked about. Gold is a safe haven asset in times of turmoil. So economic turmoil, military and geopolitical turmoil, gold's a safe haven for that as well, in a way that Bitcoin really isn't. A lot of people are talking about Bitcoin being a safe haven as well. It sort of is, but it's way too correlated to the Nasdaq right now on the positive side, in my opinion, to match the safety aspect of gold, not the performance aspect, but the safety aspect of it.
All right, you've given me a lot to think about for my gold-constructed brick wall, similar to the one that's behind you. Bobby, thanks so much. Appreciate it.
Good to see you, Brad.
Coming up, we're kicking off a week of retirement coverage with a look at how you should be investing for success in your 20s and 30s. Stay tuned. A 2024 study says there could be a looming retirement crisis in America. Morningstar Research found that as many as 45% of seniors who retire at 65 could run out of money as they age. That number climbs to 54% for workers who retired at 62. But that's not the whole story. According to the Census Bureau, as of 2022, 48% of retired adults received some form of income outside of Social Security benefits. The majority of this income came from 401k plans, while just over a quarter came from pensions and 16% came from individual retirement accounts. In its study, Morningstar even concluded that the retirement crisis could be averted, or at least seriously downplayed, if more workers had access and used workplace investment plans. So, how can you make sure to be a senior who lives comfortably off of their income? Well, it all comes down to having a strong portfolio, starting early, and avoiding the penalties that come from withdrawals. That's why this week on Wealth, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of their investments. According to Fidelity Investments, Gen Z workers have an average of $6,500 saved for retirement. Millennials have an average of $24,000 saved. But while that pales in comparison to what baby boomers have saved up, there's still time to build wealth. Joining us now with his advice for retirement saving in your 20s and 30s is Nick Nafusi, who is the BlackRock Global Head of Retirement Solutions and Head of LifePath. Great to have you here in studio with us, Nick. First and foremost, here BlackRock found that Gen Z is actually pretty optimistic about saving for retirement. So how are younger workers progressing on their savings goals?
Yeah, Brett, thank you very much for having me. I think when we think about Gen Z, they got the memo, is what I would say. So I think they're seeing this, that a lot of their parents have struggled with retirement, older friends have struggled with retirement savings. What we find is that about 77% of Gen Z workers they feel like they're going to be on track for living their lifestyle in retirement, basically meaning they feel there's a level of confidence that's higher than we see in other generations. The problem is about 2/3 of them don't know what to actually do with their money. And when people don't know what to do with their money, they leave it in cash.
Interesting. Now, Gen Z reports a lack of knowledge on managing investments. Why can target date ETFs actually be a good tool here?
Yeah, so we launched a series of target date ETFs about 1.5 years ago, simply called iShares LifePath ETFs. The whole idea of that was about half of the country has access to a 401k plan. We know that half of the country actually is on very good footing. The other half doesn't have access to a 401k plan. So what we've encouraged people to think about is using a target date fund. The idea of a target date fund is it takes the guesswork out of investing for you. Starts off with more growth assets, and then as you get older, it becomes more conservative, preparing for retirement.
And so millennials, in this survey data that we were combing through here, they actually reported being overextended. If you have a lot of expenses, how should you be really thinking about retirement saving here?
Yeah, you have to make retirement savings an absolute need for what you're doing in your lifestyle. I think of it like a cost, like any other cost you'd have. The difference is this one's going to benefit you in the future. So we think of savings rates. People often ask how much should they save, and my answer is usually more. But it start off with something small, 5%, 6%. Make sure you're saving to that 401k match, and then every year try to raise it by about 1 or 2 percentage points to get to higher levels.
What types of accounts are best for retirement savings and plotting that out?
So a lot of it depends on where you work. If you have access to a 401k plan, you usually have access to a corporate match. What a corporate match means is your employer will give you money if you're saving as well. So you always want to start with your 401k plan and save up to that match. Once you've done that, that's when you want to start looking at something like a Roth IRA. And then if you've maxed out the Roth IRA, maybe there's income tax reasons why you might want to consider a traditional. But always start with that 401k to start, because if you can get that free money from your firm, it's very important.
Okay, so a lot of people are trying to figure out, all right, what's a general number that I should have for each age? And if we're thinking specifically about 20s and 30s, what is a good number to keep in mind?
So this is a tough question to answer. So finance is often ruled by rules of thumb. So I'll try to give you a rule of thumb here. So think of it as 1, 3, 6, 9.
Okay.
1 times your total comp saved by the time you're 30, 3 times by your 40, 6 times at 50, and then when you're approaching retirement, it's about 9 or 10 times your total comp. So multiply that out, and that's how much you should have saved. It's a rough rule of thumb. It's kind of one of those gauges to see how close you are to being on target.
How do you make sure that you're not falling behind? Is it ever too late to start in that that saving effort?
No, it's never too late to start. What we try to do is we try to talk to people in their 20s and 30s. It's one of those things that you've got a very long time horizon, 40 years until you're going to retire. But that compounding that happens when you're young, so if you can start off saving when you're young, this is the whole idea behind the LifePath ETFs. We could take all of that institutional knowledge we have working with 401k plans, apply it into an ETF wrapper. As long as you have a brokerage account and about $30, you can open up a single share of the LifePath ETF. Yeah. The idea then is you start compounding and you start on that savings. What we know is when people start investing, they're more willing to invest more in the future.
Certainly. What about for those who are listening to us and they're saying, well, wait a minute, guys, like, I went to college. I have this massive amount of debt that I took on. It seems like I would be better prone paying that down than starting on that retirement savings. How do you kind of go around that conversation?
Yeah, it's a fair point. Some firms are starting to address this now in their HR and benefits plans. What you're really looking at is what's the amount that you're paying on that debt versus what you think the expected return is on equities, primarily when you're young, because that's where you would be invested in. So historically, S&P 500's done about 8% going back decades, not just in the last 15 years, but going back longer. So if you're paying more on your debt than that, you're probably better off paying down your debt. But again, what we want to do, even at a small amount, you still want to start savings, because once you have that account opened up, once you're starting to put some money into it, you're more willing to do it in the future.
Nick, great to have you here in studio with us. Thanks for breaking this down.
Good to see you. Thank you.
Likewise. Select Denny's locations will add a surcharge for eggs amid a nationwide shortage attributed to bird flu. Denny's confirmed the news in a statement to Yahoo Finance, saying some of the restaurants will need to, quote, temporarily add a surcharge to every meal that includes eggs. This pricing decision is market by market and restaurant by restaurant due to the regional impacts of the egg shortage. Denny's says it will not be providing individual market and restaurant lists to local inquiries, as this is a fluid situation. Coming up, a bright spot for first-time home buyers in a tough market. That's next on Wealth. This Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, the change makers who have advanced economy and society. Toni Townes-Whitley is one of 2 black women CEOs in the Fortune 500 and the first black CEO of a publicly traded defense company. Townes-Whitley became the CEO of SAIC on October 2nd, 2023, whose headquarters are in Reston, Virginia. She's a graduate of Princeton University with a degree in economics and public policy, who also served in the Peace Corps in Gabon in Central Africa. Since becoming CEO, Townes-Whitley has had to navigate the company through geopolitical conflicts and now has the tall task of growing business while government slashes spending. Here's what she had to say on Yahoo Finance during 2024.
We continue to bring capability. We're an integrator, a mission integrator that integrates technology from a startup all the way to a hyperscaler, large cloud provider. We integrate, we plug and play. So in that environment, as an integrator, there's always a demand signal for us to continue to integrate and bring the best technology to the Department of Defense and to the intel agencies. And then on the civilian side, again, we find ourselves with State Department, with Department of Transportation and others. We still see a very solid demand signal there, even in the geopolitical environment that we're in.
A recent Zillow survey found a bright spot in the troubled U.S. housing markets. The percentage of Black first-time home buyers actually held strong in the past year, even as the overall rate of first-time home buyers fell. With more on what's driving that trend and what it means, we're joined by Zillow senior economist Orphe Divounguy. Orphe, great to have you back on the program with us, and good to see you.
Thanks for having me.
Certainly. Let's break this down in the findings that we've seen among Black first-time home buyers and the rebounder that you're tracking there.
Yeah, absolutely. You know, the market housing demand has kind of eased in the past couple of years, but what we're seeing is Black potential home buyers, first-time home buyers, haven't given up on home ownership despite the major affordability challenges. Our survey showed that the share of Black home buyers purchasing their first home is holding steady above 60%, even as the national rate has declined. There's a large pool of Black potential home buyers out there. Remember, less than half of all Black households own their own home, compared to roughly 65%, which is the national average. But there's good news, right? Technology is helping. Mortgage data shows a lack of credit history is the primary reason for Black applicants' mortgage denials. The push to make utility payments and rent payments count towards someone's credit history is going to help. Zillow Rentals reports basically on-time monthly rent payments to the credit bureaus. That's a step in the right direction. Shoppers also have access to local down payment assistance on every single Zillow listing. And so technology is helping to close the gap, and despite, of course, the affordability challenges that we're seeing today.
And so it sounds like technology is contributing to that rebound. I wonder which metros you're also seeing really showcase the biggest spikes in home ownership.
Yeah, look, the reality is like the number of listings on Zillow that are affordable to the median household, Black household, has declined over the past couple of years. But you have markets that are relatively more affordable. And those are markets where new construction has really created pockets of affordability. You know, if you look at some of the southern markets where you see a lot of home building, there's still a lot of housing listings that are affordable to, the median household, but even lower income households, and that are contributing to the fact that some people are still able to get on the first rung of the housing ladder.
So in affordability, what are you seeing there? As this is an extremely high level of costs that we've seen on a historic basis for the upfront fees and ultimate prices that potential homeowners need to consider as well.
Yes, of course. You know, the affordability remains a major challenge. The good news is, as more listings come online, right, we see more housing supply in 2025. And as mortgage rates continue to ease, what we expect is to see a small rebound in housing activity, small rebound in sales. And I think that's really going to help those who had been kind of outbid during the pandemic, those who actually were forced to sit out the unsustainable pace of activity during the pandemic. And so those people that are ready to buy now should actually benefit from the small rebound that we're seeing in the housing market. We're seeing more listings, more inventory. Inventory is coming back online. So buyers have more options and more bargaining power. Now, there's some risks to that. Some brokerages, especially large brokerages, are trying to keep some listings off the multiple listing service. And so exclusive listings would be a step backward. You know, it would create a markets for the haves and the have-nots. What we need is all listings available to all people. And if we have more listings on the housing market, more Black families will have access to all neighborhoods across the country. We don't want to go back to a time where listings were restricted for certain groups only.
Yeah, absolutely, Orphe. You know, just lastly, while we have you, we got about 30 seconds here. How would you describe the overall housing market right now?
Yeah, it finished the year on a strong note. We had existing home sales surprise on the upside back both in November and December. New home sales did the same. We started the year with a downbeat report on existing home sales, but essentially mortgage rates have been declining since mid-January. And so the combination of more inventory is up roughly 17% when compared to a year ago. So more inventory, but also easing mortgage rates as we continue into the year should make for a stronger home shopping season than we had last year. Zillow forecast 4.11 million home sales in 2025, a small increase from the 30-year low that we saw in 2024.
Orphe, always great to grab some time with you. Thanks so much.
It's a pleasure. Thanks for having me.
Certainly. Let's do a final check of the markets here as we're taking a look at the major averages. The Dow, the S&P 500 right now in positive territory. The Nasdaq still in the red, down by about 0.4% right now. Leading the pack today, at least from a sector performance basis, healthcare is up. However, bringing up the caboose if you've got consumer discretionary right now. More gainers than decliners, though, on the sector basis. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. Stay tuned. Market Domination comes your way, 3 p.m. Eastern Time.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We are 2.5 hours into the trading day. It's time for Yahoo Finance's Market Minute. Stocks are mixed this morning as markets attempt to recover from Friday's sell-off. Apple announcing it will add 20,000 jobs and spend $500 billion in the U.S. That's over the next 4 years, including a new facility in Texas. It's going to be used to build servers to support Apple Intelligence. Nvidia is the top trending ticker on Yahoo Finance ahead of its highly anticipated earnings report Wednesday. The results come amid pressure on the broader tech sector after a note from TD Cowen raised some concerns about AI spending. And Nike is rallying on an upgrade from Jefferies, a team there naming the stock a new top pick. They're bullish on CEO Elliott Hill's focus on restoring wholesale partnerships and also his attempts to drive innovation. And that's your Yahoo Finance Market Minute. For more on what is trending, you can scan the QR code below to track the best and worst performing stocks of the session.